Linda Ison. All right, I'll circle back for her. Tim Jennings.
Here.
Harold Lavender.
Here.
Lee Ross.
Present.
Nick Payas.
Present.
And Commissioner Vice Chair, we have been advised that Michael Messina is not available to join us this morning, but you do have a quorum. And as I see,
if someone could reach out to Linda though to just make sure that she's not having any trouble getting on.
SIC staff, Steve Moise.
Here.
Vince Smith.
I'm here.
Evan Land.
Good morning.
Brent Shipp.
I'm here.
Charlie Woolman.
Present.
David Lee.
Here.
Paul Chapman.
I'm here.
Charlotte Bennett.
Here.
Chris Cassidy.
Here.
Clay Camper.
Here.
Clayton Cleek.
Present.
Mikhail Kuznetsov.
Present.
Bruce Brown.
Here.
Nino Carpenito.
Here.
And from RVK, on the phone we have
Marcia Beard.
Matthias Bauer.
Bauer and Matt Sturdivant.
thank you. And from Townsend,
We have Jack Oak, Seth Marcus, and Andrew Bradley. Good morning, everyone.
and do we have anyone from Axia on the phone?
Yes, we have Jennifer Wildman and Timothy Neff.
And anyone from Bell?
Lily Dunn and Joe Cannon.
And Brookfield.
Good morning, Chris Harris and Hadley Pierre Marshall.
And are there any other participants that I have not identified? Linda, did we have you join us? Linda Ison. Commissioner, I'll reach out to her now.
All right, great. Harold, are you ready? Are you prepared to make the motions for the investment votes? Should we not have Linda join us?
I'll be happy to do that, Madam Chair.
All right, can I have a motion for approval of the agenda, please?
So moved. Second.
Can you identify yourself?
Harold was the mover.
MJ, second.
Madam Chair,
The motion.
Tim,
I have a question.
Yes, Tim.
Thank you. On 4G, G isn't good. I thought when I first saw the agenda item that it would just be informational, but then on the next page of our book under tax stabilization 4G, there is a motion there, yet there was no input, or I didn't see it in my packet on what the reallocation was going to be. And I just guess it's a question more for Vince.
For Vince, yeah. Vince, do you want to address that?
Sure, yeah. So the council requested a discussion, or the investment committee requested a discussion on whether we should make an adjustment to the real estate exposure to that portfolio. We don't have any materials. We're going to engender a discussion on whether or not we should make that move.
Okay. All right, thank you, Madam Chair.
So just to be clear, the vote today is not to actually do the reallocation, but just to, I'm sorry, can you repeat that? I didn't quite understand.
Sure, Madam Chair. The intention of the investment committee was just to have a discussion. I think there's probably a motion in there in case the council decides to make a move, but what the investment committee was interested in was having a discussion at the council level.
Is there a revised asset allocation in our packet though?
I'm sorry, what was the question?
Is the revised asset allocation, is that included in our packet?
No, what the investment committee was or wanted to be discussed was should we have a 20% allocation to that portfolio, they wanted the council to have a discussion if we should raise liquidity with half of that, so to take it to a 10% allocation.
Yeah, that's a real estate allocation.
That's right, in the TSR.
And so we would be voting to bring that to 10% today, or just have a discussion?
Well, I think the investment committee wanted to have a discussion, but I think, and Steve's probably better to answer this, I think there's a motion in there in case the council wants to make a move.
That's correct.
So is that satisfactory to you, Tim, or you want to make a motion to take it off? What do you want to do?
Madam Chair, I would love to have the discussion. This is Tim. I'd love to have the discussion. It was something that was discussed, at great length when we put it in at 20%. But I don't think we can have a motion today to change it since it wasn't advertised.
Okay, so we'll just have the discussion then. So do we need to have a motion to have that removed from the agenda as a voting item? I'm not clear.
Well, it doesn't. I'm happy to make that motion, Madam Chair, that we revise the original motion to make 4G discussion purposes only.
Okay, do we have a second?
Second, this is Olivia.
All right, with a motion and a second, we have an amended agenda. Do we need to take a roll call vote on an amended agenda?
I don't think so.
All right, so are there any objections to the amended agenda?
No.
All right, all those in favor signify by saying aye.
Aye.
Aye. Aye. Okay, with that we have an amended agenda. So we're going to move on to the consent agenda, which has 3 items: the approval of the minutes of the March 24th meeting, the approval of the minutes of the April 7th meeting, and approval of William Blair International Equity Investment Management contract renewal. We're going to take this all as one vote from the consent agenda. So is there a motion for approval of the consent agenda?
Moves approval of the minutes. I'll second. This is Harold. I'll second.
Okay, we have a motion and a second. Is there any discussion of the consent agenda? All right, we will be taking a roll call vote on this one, Kerry.
Commissioner Garcia Richard.
Yes.
Madam Chair,
Yes.
this is Nick Taylor.
Yes, Nick.
I had a question on, I think it was, this RVK, the approval of William Blair International Equity Investment.
Okay.
And it's sort of just a technical thing, but if you look at the memo that was handed out to the council, it references that the method of procurement for this contract was under, I believe, statute 13-199A. I went and looked at that statute, and it does say that excluded from the central purchasing office through the state purchasing agent, there's an exclusion of the requirement of procurement under that 13-199A. But it says that we would still have to follow the procurement code. And so I don't think that statute is a viable vehicle for this contract. And if you look under the recommendation.
So So,
Eric,
Evan, do you have an answer for this, or maybe Marcia or Matthias? I'm not sure who's best to answer this one.
I do, Commissioner. This is Evan. Member Tejas, the exemption, the particular exemption for the SIC is located at 13-198 CC. So that's 13-1-98 CC. That is this enumeration of exemptions to the procurement code, and it exempts the SIC from the procurement code for contracts related to investment managers, investment advisors, or investment-related materials. And William Blair is obviously a registered investment advisor. They're also an investment manager, and it's investment-related. So it meets all three. It doesn't have to meet all three. It has to meet one. But you are clear from a procurement perspective under 13-198 CC.
and I'm familiar with that one, Madam Chair. And so that one would make it allowable, but if we could just edit this, just from an auditing standpoint, I think that if we could somehow edit this memo that is sent to the State Investment Council to clarify that it is 13-198 CC and not 199A, I think that would be very helpful. Thank you.
Thank you, Member Tejas. Any other questions? All right, Kerry, could you start the roll call vote over again?
All right, so this would be for approval of the consent agenda. So Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Secretary Padilla Jackson.
Yes.
Peter Frank.
Yes.
Linda Ison.
Yes.
Tim Jennings.
Yes.
Lee Rawson.
Yes.
Harold Lavender.
Yes.
And Nick Tejas.
Yes.
Thank you.
All right, great. And we have been joined by Member Ison. Member Ison, I don't know if you got on the call in time to see that we amended the agenda. Item 4G is going to be discussion only. So we're going to item number 3 on the agenda now, the State Investment Officer report, and I'll hand it over to Mr. Moe.
Thank you, Commissioner, and good morning, everyone. As we traditionally do at the outset of my report, please be advised that distributions from our funds in fiscal year 19, as of this date, April 2020, totaled $161,360,000. As of this date, in fiscal year 20, distributions from our two funds totaled $841,256,000, and the 12-month total distribution for this fiscal year is $1,002,617,000. Our net asset value as of the end of the day yesterday, as reported by J.P. Morgan, was $26,302,526,447. The price of West Texas Intermediate, at its close yesterday, was $12.78 per barrel. Quite a change. Moving on down, item A in the SIO report, with respect to reserve funds, as you all know, we are managing the tax stabilization reserve, as was just commented on earlier on this call. We have an agenda item, as was also mentioned, regarding whether the asset allocation in the tax stabilization fund should be adjusted. We will not have a vote. Olivia, would you have any comment that you would like to make about the possible need for any SIC held reserves, or is it a little too early for that?
Madam Chair and Mr. Moise, I'm happy to comment generally. So with respect to the budget shortfall, it is very likely that we will be using a significant portion of the reserves, including the tax stabilization reserve, over the course of the next 2 years. The exact amount that will be used in fiscal year 2021 or 22 is still up for discussion. There's just different ideas out there in terms of how quickly to access those funds. So as you know, the talk of a special session is now becoming more likely in June. And so I think that the timing is probably something that we do need to move more quickly on. The problem is we wouldn't be able to say the exact amount today. One thing we might want to consider is an emergency meeting, so that when the Craig estimates come out, which will be here in the next couple of weeks, and then more solidified plans with respect to use of the tax stabilization reserve get finalized, then we, can better advise the SIC as to how much of that they should liquidate. So that may be an option, and that may be something we want to think about.
Olivia, we'll be pleased to schedule a special meeting whenever it is appropriate. Just let us know.
Okay, thank you.
Thanks for that comment. Commissioner, do you have any thoughts that might be helpful to the council regarding projected land grant fund inflows, or is it premature to discuss that at this point?
So basically what we're seeing, and just to remind everyone that's on the call and watching the streaming, we are 3 months behind in the production levels that we announce. And so through the end of this fiscal year, this current fiscal year, we will probably still, because we are in that 3-month cycle, have inflows at the same levels that we had previously. For the upcoming fiscal year that starts July 1, we're getting ready to turn over our projections to the LFC as part of our annual budget projections. And we're probably projecting about half of the inflows that we had this year. So we're predicting about 500 million instead of the 1 billion. That is preliminary. It isn't anything to hang your hat on. We did, as you all know, undergo a emergency rule change to allow producers to temporarily cease production on some of their most uneconomical wells. And so it just kind of remains to be seen how many folks are going to take advantage of that, and how production will be impacted by that rule and by prices. That's all I have for now.
Thank you, Commissioner. I think that will help us with our planning. We appreciate that. Moving on to item 3, B3, the New Mexico Recovery Fund update. Sun Mountain Capital has provided us with the following information, which I think you will find interesting. First, on applicants to the fund. To date, Sun Mountain has received 73 completed initial eligibility applications on its website, which has only been active for 1 week now. 44 of those 73 applicants were deemed eligible for the program. 26 of those have been invited to move on to phase 2 due diligence. And 8 of those have submitted their application for funding, and they're in the next phase of diligence. Let's take a look at the applicants by data, if you will. Applications have come in, I would say, happily from 13 different counties across the state. we're very pleased to see that diversity. They include Bernalillo, Chavez, Doña Ana, Eddie, Lee, Lincoln, Los Alamos, Otero, San Juan, Sandoval, Santa Fe, Taos, and Valencia. Of the pool of eligible applicants, they have an aggregate self-reported 2019 revenue of $806 million with average revenue of about $16 million. The employment base ranges from 40 to 1,700 employees. Aggregate self-reported jobs saved metric totals 3,900 for the eligible pool of applicants. This is the employment base alone would impact or help save. Industries that have applied include the following: hospitality, oil and gas services, construction, food, beverage, healthcare, and technology. The loan requests have ranged between $500,000 and $7.5 million. So the next steps that Sun Mountain is going to be following will be to work through the applicants in due diligence, targeting issuing term sheets in the next week or so to the companies which are furthest along in due diligence. And Sun Mountain has plans to complete diligence and legal documentation with loan funding in the month of May. Commissioner, that is the update from Sun Mountain. Moving on to item C, governance. I mentioned that a governance committee meeting is to be determined. The chances are we will not have a governance committee meeting in May. Under operations, you can see that we continue to source 3 positions. I think I may have mentioned to you that we have identified 2 qualified people for the fixed income asset class director, and we're waiting to be able to have in-person interviews. Brent will be commenting on our preliminary budget, which will be submitted no later than May 1. We had a good discussion on that with the audit committee yesterday. And now under legislative matters, if I may please give you an update on the working group that's been established for House Memorial 9. As many of you know, the legislature in this memorial asked the State Investment Office to develop a strategic investment plan to help foster New Mexico's alternative energy industry. Despite everything that's happened since that memorial passed, your staff believes that developing the requested strategic investment plan is still important to the state, and we have taken several steps to begin to create the plan. So what have we done? Internally, we've begun to identify available funds, potential investment opportunities, and we've looked at the SIC's current investments in New Mexico's alternative energy industry. The memorial also asks that we consult with the State Land Office, the Economic Development Department, and on April 15th, we had a very productive initial working group meeting with the State Land Office, EDD, and representatives of 4 other relevant governmental entities: Rita, the Renewable Energy Transmission Authority, the Indian Affairs Department, the Environment Department, and Energy, Minerals, and Natural Resources Department. Finally, because developing an effective strategy is going to depend on a lot of technical expertise in the renewable world. We've had preliminary discussions with an appropriate consulting firm. Unfortunately, the memorial is an unfunded mandate that will require us to provide our own funding for any consultant we determine that we need to use. We believe that next month we'll come back to you with further information about relevant costs. We hope to be able to have completed the plan for your review and approval by our September meeting. And Bruce Brown is very ably leading this project for us. Now, council members, I want to make a public disclosure that I believe is important. I want you to know that my family is involved with a wind energy project on some of our ranch property in Guadalupe County. Our son Adam is leading that initiative for us. We've been working on this project for over 15 years. The council should be aware of this. I want to assure you that I will not allow my participation in fulfilling the mandates of House Memorial 9 to create any conflicts of interest, whether perceived or actual. If any matter involving the memorial suggests that a conflict could arise, I will recuse myself from any involvement. Thank you for letting me make that disclosure. Commissioner, that concludes my report.
Thank you, Mr. Moise, for the
Madam Chair.
disclosure and for the report. And I'm going to go to member questions. Is that a member that has a question?
Yes, this is Harold Lavender. Madam Chair, I had asked Steve to at least give a brief report. My understanding is that when we passed when we approved the motion a month ago or 2 months ago to set up the special fund, loan fund, one of the parts of that fund is that we appoint a committee, outside committee, to weigh the potential for investments in both co-investment and catalyst companies, should that be a possibility. My understanding is that's not being done. I haven't heard anything further about the committee, and I'd like to have that explained to the council, why that particular part of the approved motion isn't being done.
Certainly, I'll be happy to do that. The council's motion approving the creation of the recovery fund tasked staff with documenting the implementation of the fund. In conjunction with our staff, Sun Mountain and its council, fund documents were negotiated and signed as they traditionally are with all of our funds, and as we are required to do with the language in the motions which approve investment in various funds. Creation of this new fund involved dealing with a lot of non-traditional topics, such as the consideration of forming the committee Harold references, an oversight committee, which was initially considered by staff and the council. After a lot of careful analysis regarding the advisability of creating this committee, its potential responsibilities and associated liabilities, and how such a committee could function and should function, we provided in the fund documents, which have been signed, for forming a committee with enhanced reporting if and when appropriate. Harold, I hope that responds to your question. If you need more, I'll provide specific legal, governance, and best practices reasons in more depth for why we have not yet asked to have that committee established.
Member Lavender, you still
Okay.
have the floor.
I appreciate that. Thank you. I think that I would like to be kept abreast, or I believe the council should be kept abreast of those efforts. And I appreciate that. Thanks.
Thank you. Nothing else here, Commissioner.
Does that conclude your questions, Member Lavender?
Yes, it does, Madam Chair. Thank you.
Any other questions from members on the SIO report or the recovery fund? No questions? So, Mr. Moise, I have a question on the HM9 working group. I'm happy to hear that you had your first meeting. I got a great report from my Assistant Commissioner of Commercial, who is our representative there. And it seems like the timeline is moving quicker than I thought during this crisis. My question is, do you see at any point in this process the inclusion or need for any kind of individuals from the public who may have renewable energy expertise to be able to weigh in?
Commissioner, I think we need to wait until we are able to do the complete scoping of the project, which we're involved in right now. We're waiting to see a report that is being prepared for Rita by an internationally recognized consulting firm that has familiarized itself in depth with New Mexico renewables and the needs in the renewable world here. And after we have a chance to review that with the working group and have an opportunity to consider engaging a consultant to guide the strategy here, we'll make that decision. I think it's a little bit premature to go into that at this point in our process.
Okay, I appreciate that response, and if you could just kind of keep me or Steve Varick, who is my designee on the working group, informed on when you think it might be appropriate. I've got folks who have contacted me wanting, maybe even if not to weigh in, at least to sort of follow the process. And so I'm gonna, leave it to your expertise on when that would be appropriate.
Commissioner, we'll be happy to do that. We're trying to keep in mind the specific topics that we've been asked to address, which is how we can invest in the New Mexico renewables world to best improve our economy. And we'll be happy to keep you and Steve advised.
Great. So if there are no more questions on agenda item 3A, we're going to move to agenda item 3B, the Chief Investment Officer report. Vince?
Thanks, Madam Chair, and good morning, everyone. At the March meeting, we briefed you on 4 items that we thought we probably ought to be working on, given the downswing in the markets and the current economic downswing. So let me brief you today on how we're proceeding in those areas. The first thing was to get a handle on how long this environment might last, mainly for planning purposes. And as you all know, that's part of our investment process. As we move from one portion of the economic cycle to another, we generally try to hazard a guess as to how long that'll last before we move again into another portion of the economic cycle. So that helps inform our investing during that period. Our comment at the March meeting was there wasn't enough information really to hazard a guess. And while it's not a lot clearer out there right now, some themes are starting to form up. The economic recovery looks like it'll likely be slower, a little more volatile, and probably a little more painful than the standard V-shaped recoveries that we've seen since the 1980s. If you look historically back to the 1800s here in our country and globally, recessions that are due to policy aggressiveness or mistakes by the Fed or central banks, normal inventory and business investment corrections, or short-term exogenous shocks, things like that, they generally wind up to be shallow and recoveries fairly quick. So think in terms of 6 to 12 months in duration, maybe 0.5% to 2% hit to GDP. There are several examples of that, a lot of those since 1980. Recessions due to financial shocks like 08, 09, they tend to be deeper, but also recovery is fairly quick. So think in terms of 9 to 18 months, 2 to 4% type hit to GDP. But recessions that are due to large disruptions of the broad economy, like we're experiencing now, last the longest and generally are the harshest. So historically, they've been 18 months to 4 years in terms of a recovery and involve more than a 4% drop in GDP. We think we're probably in the second category or the third category with this event, but it's still early, and estimates and forecasts are all over the place, and of course with large deviations. So we're finding economists and strategists that are on the side of a short and sharp V, a scenario where people get back to work quickly. We have a pop in economic growth as pent-up demand is satisfied, and we get back to trend growth and business as usual fairly quickly. Of course, there's others on the complete opposite side of that that think we'll experience a long economic recovery, complete with meaningful changes to the structure of the economy and to society at large. The stock market's currently discounting a short, sharp V, but likely the answer is somewhere in between, and we're monitoring that very closely. And hopefully over the next few months, we'll have some more clarity as to how this is going to play out for us. The second item was to be vigilant in monitoring markets and rebalancing our portfolio. As we commented then, one of the great lessons from the great financial crisis was not only to have liquidity available when these events happen, and we do, but to use it and stay balanced versus our long-term allocations and risk targets. We've been active in rebalancing in the publicly traded equity area and in the non-core fixed income area, as well as meeting capital calls in the private equity, real estate, and real return areas. Liquidity has come from both the low duration portfolio and the core bonds portfolio. The third item was to closely monitor our managers and existing investments, and particularly monitor for investments that are showing signs of trouble or distress. By last count, since we've been out of the office, which I think was March 16th, the investment team has had more than 300 meaningful contacts with our managers and others since the crisis began. So we've been careful to monitor activity with our managers and in the portfolio. We've also been careful to try to balance activity like that with time for thought and analysis. So we're more proactive than reactive, or at least aiming for that. So far, our primary sources of stress in the portfolio have been one strategy in the non-core fixed income portfolio and some of our energy-related strategies in the real return portfolio. We're monitoring those closely. Lastly, we need to be vigilant but conservative in seeking opportunities. And so far, much of that opportunity has been in the credit space, primarily in investments that would be held in the non-core fixed income portfolio if we made them. The publicly traded equity market drop was swift and short, but we believe there will be further opportunity there as the economic realities of our current situation begin to be more fully priced into stocks. The bounce looks an awful lot like the bounce in 2008. So in terms of market psychology, we are expecting another downswing in stocks in probably the not too distant future here. For the rest of the portfolio, we expect opportunities to present themselves, but probably a little bit further out as events continue to unfold. That's really the macro, but I can make just a couple comments, higher level comments on that. We held up well in this environment as we were positioned to do. An initial look at March quarter numbers produced by the broad group of public funds shows the median fund was down about 12.5% for the March quarter, and land grant was down less than 9.5%. Now we would expect the more narrow group of large public funds, those that are billion and larger, they'll fare a little bit better than the broad median due to better diversification. And our first guess at that number is around a drop of 10.5% or so. So we fared well relative to others that do what you do and do what we do. We were a little weaker than expected on the benchmark relative side. The portfolio underperformed in a number of asset classes relative to benchmarks for the quarter. Marcia and Matthias will report those to you, and we are investigating where necessary. Our liquidity has been well more than required, and we continue to have plenty of reserves if there's further downside in markets. Lastly, we would expect some of the downside. We would expect some more rough sledding over the next couple of quarters, but I feel like we're very well prepared if that eventuality happens. So with that, Madam Chair, that concludes my report, and we'll take any questions that you might have.
All right, so before we go to RVK, I'm going to go to the committee to see if there are any questions for you, Vin. Any questions from committee? All right, with that, we're going to move to item 3C, the performance report, and if we could hear from RVK on that.
Thank you, Madam Chair, and Vince for that introduction. Thought maybe I'd start with just a couple comments to put this year into perspective, and then we'll dive a little deeper into the actual results. This first quarter of 2020 was historic, not just for financial markets, if you look at the performance over that period, but really on all of our individual daily lives as the virus turned into a global pandemic. Excuse me. The virus, as we all know, it spread rather quickly and indiscriminately, touched all parts of the globe, and really put a tremendous burden on the global healthcare system. And as a result of that, there was little choice but to essentially close all non-essential businesses as they've been deemed to contain, or at the very least, slow the spread of the virus. Now, the reason why that's been so, well, unprecedented, is that word tends to get overused as of late, is what it's done to our unemployment numbers. And I think it's important to keep those in mind. As you've probably seen, those numbers have skyrocketed, and in a lot of ways they continue to rise, with claims now over 26 million. When you put that into perspective, it's really quite tremendous, because what it's done is raised the 20+ million jobs that have been added over the last decade or so since the GFC. So in just a matter of a couple weeks, you've essentially unwound or undone a decade worth of employment progress. Now, not all of that is going to necessarily stick as we move forward, but in the present situation, that's quite meaningful. Also know that, and data supports it, that when you have unemployment for sustained periods of time, that can and often does change the future spending behavior of consumers. And that's relevant because consumption represents around about 2/3 of U.S. GDP. So if we don't have confidence in the markets and in the consumer, then that will have long-lasting effects in terms of our forward growth outlook. It's already been alluded to, but the markets actually started reasonably strong. It didn't start to discount the spread of the virus until much later, the end of February. But the sell-off that happened after that, and for the next 4 weeks, was pretty astonishing. And we've done a fair amount of modeling around that to see what that drawdown looked like. You may recall that as part of the liquidity analysis, we modeled a 35% type of a drawdown in various scenarios. So we wanted to see what that looked like. And really the speed and the magnitude is fairly unusual when you compare it to the last 40 years rather. So just for perspective, the S&P 500 sold off a little over 30% in a 1-month span. During the GFC, it took nearly a year to get there. So it was much quicker. And I think as a result of that, you felt that pain a little bit more immediately. One thing that's also been noteworthy and that flows through the investments and the relative performance that Vince just mentioned is that big and steady secular growth stocks, so technology, healthcare, consumer staples, are the ones that are holding things together right now, and are the ones that have been performing in this more recent start of potentially a rebound. Now, we don't know if it's going to have another leg down before we're out of the woods. But those are the same types of stocks that have been doing well leading into the strong. So that's fairly unusual and has some implications that we'll touch on in a little bit. I think also noteworthy is that the five, and this has been a developing trend, I think we've talked to you about this previously, but the five largest stocks in the S&P 500, and when you look at the types of names that are doing really, really well, Amazon obviously is sort of the front of that. The five largest stocks in the S&P 500 are now comprising 20%. And so that is a tremendous amount of concentration at the very top and has implications in terms of what's done well. Really, growth stocks and those that are the biggest have done quite well. And so when you look at the capital markets in general and certainly in the equities, they've been positive in April, which has been, I think, fairly difficult for most investors to reconcile, given where fundamentals still are and the realities of Main Street. When you have unemployment numbers the way they are and you're really not that far off of peaks, that's somewhat concerning. I think for reference, Vince already mentioned peer performance, and overall the portfolio held up quite well, although I think on a relative basis, we would have liked to see a little bit better performance. When you look at the attribution and when you look at some of the comments I just made in terms of what's worked, that's been unusual, and I know that Marsha and Matt will talk about that a little bit more. But for reference, the 70-30 portfolio was down 13% for Q1. So again, that's just 70 equities, 30 fixed income, sort of a very naive type of reference benchmark, and in line with, I would say, the broad peer group there. But you're up 7%. That same portfolio is up 7% in April. I'm not sure enough has happened to justify that, but again, a lot of actions in terms of stimulus is forcing a lot of investors into risk assets and the equity markets, because all the other parts are so unattractive given where rates are. And so equities, of course, always receive the most headline attention, although I think there was lots of other interesting parts in the capital markets that were also impacted during that period. Fixed income, namely, we saw treasuries, so safe haven assets, which tend to be treasuries and other very high quality instruments, always do very well when you have a flight to quality. This time was no different. And treasuries and anything that had a good deal of duration was rewarded as those interest rates continued to move lower. Now we saw credit spreads blow out, although they've come back in some already, and we saw some signs of liquidity constraints, although much more orderly than what happened in 2008, 2009. So there were certainly some lessons that were learned there that I think helped at least that aspect of it. So, but because of what happened in the credit markets, and Vince mentioned, there's been good opportunities that come out of that, whether it's in dislocation type funds. There's a TALF 2.0 that was first initiated in 08-09 that's coming to the fore. There's different opportunities in the credit space that are certainly coming out of that, and I know that they're getting a close review. But the sell-off as it relates to the credit market was really across the quality spectrum, and so that's noteworthy. And as you look at not just high yield and bank loans and things that are below investment grade, but even investment grade credit were some of the lower performers, and that had implications on the fixed income holdings. So anything that wasn't essentially treasuries or longer dated bonds, we're going to fall short of the rest of the sectors. I think I'll try to wrap up my comments and conclude here, but I think it is important, certainly when you have difficult times, to just recall that these types of market dislocations have been well contemplated by this group through the liquidity study, through the stochastic asset allocation modeling that we periodically perform and review, and so these types of results are certainly within that range of potential outcomes, and short of a change to an investment horizon or investment objective of the assets, I think we all could probably agree that the strategic asset allocation that you have certainly remains advisable. Although, as Vince will tell you, we're certainly working to re-underwrite that as we do quite often, and we'll bring that forward in the coming months. So maybe with that, I'll wrap it up and see if there's any questions or comments that I might be able to address before Marcia walks us through some of the specific investment results.
Thank you, Matthias. Marcia, did you want to weigh in at this time before I go to questions?
Thank you, Madam Chair. I'll take you through the performance report, and thank you, Matthias, for the kickoff. Let's go to page 26 in your diligent. And just to mention, this is a preliminary report for March, the end of March 2020. On page 26, you'll see that we have a total fund performance for New Mexico SIC, but then we don't have a stated return for land grant or severance at this time. That's why this preliminary report. But to a couple points that both Vince and Matthias made, if you look at the interim policy index for both of the land grant and the severance, you can see those numbers. They're hard to see. They're a month fall of over 5.5%. But we think that your allocation actually will serve you well. What they also mentioned is that managers underperform their benchmarks pretty much across the board by asset class. There's also some structural things we can talk about, but the total fund was down over 6% for the month. So if we compare that to the policy index returns, we know that there was some manager underperformance. Underneath land grant and severance are the asset class composites. You will notice the global equity trailed. You'll look at that. You can look at the U.S. and non-U.S. We have Matt Sturtevant, who's the direct manager, research director for equity at RVK. He's here for an item later on the agenda, but we thought since he's here, we'd have him speak to the U.S. Portfolio and the non-U.S. Portfolio as well. Matt?
Absolutely.
No, thank you, Marcia. I'm sorry to interrupt.
No, please proceed.
Okay, thank you. And I'm happy to provide more context on the equity portfolio performance. It's something we've been talking to a lot of clients about because it was obviously very unique quarter. I think the context I can provide is heading into the quarter, this portfolio was positioned in a fairly conservative, relatively conservative fashion with slight overweights to stable cash flow sectors like consumer staples and utilities. And really had coming into this a lower volatility than its benchmark. And I'm speaking of the U.S. equity portfolio where we saw the underperformance occur. Heading into the quarter, I think we would have felt pretty good about the probability of outperforming in a given market downturn, but the unique characteristics of this one were challenging, and challenging enough that normally when we see this type of drawback, we would expect active management to provide some level of protection. But overall, just outside of this portfolio, active managers did not provide that in Q1, with over half underperforming after fees are accounted for. And a big reason why this U.S. equity portfolio and many active managers did not perform well was something that Matthias alluded to, which was a very strong performance from the top stocks in the index, the largest stocks in the index, the most popular trades coming into the index. And that's something we actually try to limit exposure to, not to be fully underweight or zero weight, but to have more than one potential return driver in the portfolio at any one time. Unfortunately, that diversified approach was the core issue in the first quarter, of being more diversified than the benchmark and not being overweight the largest stocks, which have gotten larger and larger over the last few years, was a key driver of the underperformance. And if you compare that to the international equity portfolio, which does include many of the same elements that the U.S. equity portfolio does, which is the use of active management, the use of factor-based investments, and that portfolio did provide some degree of protection. And a big reason why is the non-U.S. space is much less top-heavy. That mega cap segment is much less impactful on overall returns. And the same trends that we saw continue in U.S. equities, such as growth stocks doing better than value stocks and large stocks doing better than small stocks, were still evident in the non-U.S. space, but to a much more muted degree. And so that's all to say that we are taking a close look at each strategy within the portfolio, and have been conducting a study of the portfolio to help pinpoint where we could make improvements. And I'm happy to answer any questions on individual strategies, but from a composite level, those are the main issues of impacting performance. And Mark, I turn that back over to you.
Thank you, Matt. Any questions for Matt before I move on to the other composites?
Yeah, this is from committee. Yes, this is Linda Ison. Although our equity performance for the quarter was a little bit lower, the fixed income was actually greater difference between benchmark and actual performance. Can you comment on that?
Yes, that's where, to do that, let's go to page 30 of the report. This looks at the fixed income composite in total against the U.S. Universal Index, and then the core fixed income portfolio and the non-core fixed income portfolio. Let's focus on the core fixed income portfolio first. As Vince had mentioned, you gave up some duration in that portfolio to have liquidity, and that has been discussed over the last several months. So to have liquidity, you did give up duration, but I want you to look at the month-to-date returns. Across the board, negative with the exception of the U.S. Treasury investment with BlackRock. So in this flight to safety, Treasuries performed the best. Now, if you look in that core, you'll see two that performed very disappointing returns with the PIMCO investment grade and the PGIM Bloomberg Universal. Now, with PIMCO, it's credit, not treasuries. And with PGIM, we've spent a lot of time talking with PGIM because they did have a very disappointing month of March. They're not invested in a traditional ag portfolio. They're a universal portfolio, so they do have exposure to EM debt and other asset classes that performed very poorly in the month of March. Just as an update, we've talked to PGIM and many of those sectors which brought them well below their benchmark for the month, have rebounded in the month of April. So comparing PGIM to the ag, I mean, the ag is the stated benchmark, but it is universal. They are a universal portfolio, so they do have exposure to sectors that did not do as well. But we hope to see their April returns rebound in that portfolio. On the non-core, this is you can see all the, we have the absolute return. A couple things that are most notable here in the non-core portfolio. You have your public market strategy fixed income pool. And just a reminder, but when Bart did his structure discussion earlier in the year, that name was changed. That's really what's in the public market strategies is your Shankman high yield portfolio, although it's short duration, it is high yield, and also the Loomis portfolio, the unconstrained portfolio. So, you know, obviously high yield in a risk off market environment, high yield did not do well. Also, some of the adjusted rate issues did not perform well. So we see that negative 5% return in the public markets, which is again the unconstrained and high yield. We've seen some bounce back in high yield in April. Also underperforming, disappointing is your bank loan pool, and just the nature of bank loans and being an adjustable rate in an environment, the interest rate environment that we had in March. We would expect that portfolio to not perform well. But I will say in the non-core, just a reminder, in the non-core portfolio, that benchmark is lagged a month. So, and again, these are preliminary numbers, but that is lagged a month. So that makes the underperformance even more dramatic. So I hope that's helpful, Linda. Any specific other questions on the fixed income portfolio? I will mention that we are, as I said earlier, in April, seeing some bounce back. The high yield index is up over 3.5% in April. Bank loan index is up well over 4% in the month of April. So hoping to see some bounce back in April.
So Member Ison, is that satisfactory? Do you have more?
Yes, Marcia, thank you for the explanation.
Thank you. I take you then to page 31, and as we mentioned, this is a very preliminary report. Private equity, the real estate, those, there's only one item on this report that is as a publicly traded number that, and we need to talk about MLPs. MLPs, as you would expect in the falling oil month of March, you can see MLPs did poorly. Harvest, which outperformed the benchmark, was down almost 41% just for the month. The benchmark was down over 46%. So as you have lived through in your state, the effect of the drop in oil affected this portfolio. Now, and this is not to downplay that return, but I will mention that the MLP index as of yesterday was up over 32.5%. So there is some recovery in that MLP. Certainly so far this month, not taking away the month of March, but has rebounded significantly in April. As I mentioned, the other numbers on this page are private markets, and this is a preliminary report. So that's MLP is what I wanted to focus on this page. So all in all, a very tough month across the board for each asset class. And we have seen some rebounds in April, but this portfolio is going to feel the pain of March for a while, as Vince and Matthias spoke to. With that, Madam Chair, if we take any questions.
Do we have member questions for Matthias, Marcia, or Matt?
The 3M.
Madam Chair, this is Tim. I have a question for Marcia.
Mr. Treasurer?
Thank you. Marcia, if you go back to page 30, because I would have bet a month's salary that that our core would have been higher than our non-core in our losses. But then I look at the non-core fixed income pool, and that's zeroing out. Can you go into that a little bit more? And is that the difference? Because it just, to me, the core should not have underperformed the non-core. So can you, I mean, maybe I just have it backwards, but it just didn't make sense to me. But I'm assuming it's because of the pool. Can you go into that a little bit more?
Are you, so you're talking about the under non-core where it says non-core fixed income pool?
Yes.
And that is made up of, let me see. This was repositioned with this composite. I'm going to another page trying to figure out what is completely in. Look at the Rio Grande and non-core pool.
It just, I mean, Marcia, I just can't understand how the core underperformed the non-core. I just look at those two numbers and go, wait a minute, they should have been reversed.
So are you looking at the bolded non-core fixed income versus are you looking at the two composites or not that subcategory in the non-core that's at zero? And we'll have to give it back. Yeah. I don't know what the underlying managers in that non-core pool is. Okay. But in general, if you look at the core fixed income portfolio, there's a lot of core plus in that portfolio as well. Through, PIMCO has some high yield. It's investment grade, but there are some it's not just all investment grade credit. PGIM, I think, is a big detractor, and they had some emerging market debt. They had some CLOs, RMBS, those sort of things that did not do well in this market environment. You look at your Loomis sales, Bloomberg U.S. Universal, that's also the Universal Index, which also includes plus sectors and in the portfolio, not just treasuries and corporate credit. So within your core, you had diversified, and at times that has served you very well. It certainly didn't help you in the month of March, where it was a complete flight to safety. And if you weren't in treasuries and had the duration equal to the benchmark, you did not fare well in the month of March. Now, what we said is that has reversed somewhat, but yes, the core portfolio, what is called or put as core, wasn't strictly core, wasn't just completely investment grade or completely treasuries. So there was underperformance in those plus sectors.
Okay, I'll have to go back and do my work there again.
And when we have the full next report, we will have those manager pages in there that will show by manager the allocations.
Madam Chair, if I could, I'd like to ask Marcia about page 28 as well.
And I also forgot to say that, remember that there was liquidity, the duration, you gave up some on duration here as well, which was something Vince had talked about over the last several months in that portfolio, having some shorter duration in that portfolio in an environment where rates were going down hurt that portfolio as well. So there were a lot of things going on, the plus sectors, the shorter duration that affected the core portfolio in March.
Okay.
And you said 28?
And page 28, if you would.
Mm-hmm.
And I'm specifically looking under the large cap, AQR, as well as anti-Cybeta. Because when I looked at those, And we're going to be voting on that later on in the meeting, and that's why I spent a little bit more time with that. But both of those, in my opinion, have underperformed their benchmarks since inception. So,
I would, and Matt and Starla are probably best to talk about this, but I will say that those are, more factor-based portfolios, and just the nature of factor-based portfolios, factors, tend to be biased against the larger stocks in the index. And as Matthias and Matt both pointed out, that it was just a handful of stocks that did, very large stocks that did well, not just in March, but leading into this drop. The leaders in the upside that we were experiencing earlier were also leaders in this drop, which is very unusual. So, Matt, I don't know if you want to expand on that.
That's exactly right. And those two strategies are great ones to point out because they are a microcosm of what affected this portfolios and many others that both seek to provide a wider base of diversification than the index. And unfortunately for this period and really the last couple of years leading up to it, where that mega cap segment has driven market returns, that increased diversification and consequent underweight to that larger cap segment has been detrimental. And we are taking a very close look at both of those strategies. And what you'll be voting on later is actually not a renewal or an underwriting of these strategies, but an allocation decision over whether we should have more flexibility on around the target weight. So we'll review that as well. But for these strategies, you're right to point them out. I would characterize both sets of performance as disappointing and ones that we went in expecting more from. And that is the case, and we are taking them under full review.
Madam Chair, if I could, so Matt, Marcia, whoever, what is your thoughts on long-term outlook for our factor strategies? What do you see a year from now?
Well, given that they tend to overweight more economically sensitive and then in some cases more mid-cap stocks or smaller cap stocks within their segment, I would expect them to do fairly well in a rebound if we do see continued recovery. If we do see a double dip in the market, which we certainly could as more negative news comes out, it is less certain over whether or not they would perform as they did in March or if they would protect. And that uncertainty really lies on whether or not, if we were to go through a second dip, if that mega cap segment were to hold up better again. But if we do continue to recover, and depending on how long term we're talking, these are exposures that have paid off over the long term. But this really, it's been a 2.5-year period at this point that has been very detrimental to these types of strategies. And we do have them under full review, and we're also trying to balance that with not overreacting to this. But we did expect more of these strategies coming in, and long term, we have to take that into account for the long term picture as well, if we want them as a piece in the portfolio or not. But if we're talking shorter term, I would say I would expect them to do a bit better as smaller cap or more economically sensitive stocks do better as the recovery continues. And longer term, we would expect returns to be more evenly distributed across the equity universe rather than simply concentrated within a small subset of mega cap stocks. And that would be generally helpful for these strategies.
Thank you, Madam Chair.
Any other questions from committee? All right, thank you, RVK.
Thank you, Madam Chair.
We're going to move now to agenda item 4. I will turn it over to the Investment Committee Chair, Member Ison.
Good morning. We had a very productive investment committee meeting, and Commissioner Stephanie Garcia Richard joined us, which was very helpful. Just to give you an overview for our voting items today, the CIC has reviewed and approved the Bell Institutional, the Brookfield Infrastructure, and the Domestic Equity International interim allocation range have been reviewed and approved by the CIC. We have not reviewed the fact sheet contract, the parametric derivative overlay, although that was previously discussed with the SIC at our last meeting. We just didn't know which manager we were going to actually look at. And we did bring up a question whether it would be the tax stabilization reserve or the tobacco fund that would be used first if the current budget dislocations due to our double crises cause the legislature to need to use some of the funds we're managing. And so I will ask whether it's Evan or whether it's Charlie or whether it's Steve, if they know which order they would probably use these funds. And we talked about wanting to have those allocations come before the SIC to make sure that we're comfortable with the allocations, with the likelihood that some or all of those funds might be liquidated due to the budget challenges. We were very happy that the commissioner was there because she gave us an update like she did today on what we're going to expect from inputs from the land office. So that's a quick review of what was covered at the investment committee meeting. Thank you.
Charlie, I know Charlie, you've had discussions, excuse me. Commissioner, it's Steve. Charlie, you've had discussions, I know, with DFA, and I know Olivia is well informed on which fund might be used first. Charlie, do you want to comment?
Commissioner, Madam Chair, the TSR is first in line. That is what will be drawn down, as Secretary Padilla Jackson commented earlier. Tobacco is pretty much last. It's the last pocket that they can go to. Pretty much everything else has to be cleared out before they go to tobacco.
Okay, so any questions on the investment committee report before we go into the voting items? Any questions? All right, let's start with agenda item 4B. I'll turn it over to our staff, Paul and Townsend.
Thank you, Madam Chair. This is Paul Chapman, Director of Real Estate and Real Return. We also have other staff on the line, Clay Camper, Nino Carpenito from my team, our consultants, Jack Koch, Seth Marcus, Andrew Bradley, and then from Bell Partners, we have Lily Dunn, who's President and Partner of Bell Partners, and Joe Cannon, who's the Executive Vice President of Investment Management and Partner on the line. Staff and Townsend recommend a commitment up to $75 million to the Bell Institutional Fund 7. Bell is targeting, and I think if this investment is approved, will actually achieve a $950 million target fundraising for a closed-end commingled fund, value-add multifamily investments across the U.S. The target return for the fund is in the range of 11 to 13% net IRR using 60 to 65% leverage. Some key considerations from our perspective is that we are seeking to increase our exposure to the multifamily sector. At present, our real estate portfolio is slightly under Odyssey, our benchmark to multifamily, but with Bell and other recent commitment activity, we'll ultimately get to a slight overweight position relative to our benchmark. Page 72 of your diligence package, which is page 4 of the Townsend cover memo, has a chart which shows our projected exposure by property sector. And we're striving to maintain an overexposure to industrial and multifamily, which are the two sectors that are expected to perform best, both in the short term and in the long term, under and we're also seeking to retain our underexposure to retail and office, which are not expected to perform well in the current crisis nor in the longer term. The proposed commitment will help move the overall real estate portfolio towards a targeted 55%, 45% core, non-core ratio. Currently, we sit at 66%, 34%. We think this is a good opportunity to take advantage of likely distress situations and obtain attractive acquisition pricing. And I will note in your materials from Townsend the strong historical track record of Bell in executing similar strategies. Speaking of strategies, I'm going to leave that to the Bell team to cover, but I do want to point out one risk that Townsend highlights in their in detail report. The fund acquired 3 assets in December of 2019 and January of 2020, which are projected to represent 13% of fund equity. Townsend notes, and we agree, that any asset purchased prior to the COVID-19 pandemic is anticipated to experience a value adjustment. It's uncertain just how much that adjustment will be. We can look at the public markets and how the REITs are trading. We think they've overshot how much of a value decline there will be, but I think there's a lot of talk on the private side that maybe multifamily might have fallen as much as 10%. However, between the lack of a promote to the operating partners and the absence of a GP incentive fee catch-up, which saves us about 100 basis points at the higher end of the return range, the upfront diminution in value from this 13% pre-specified portfolio is expected to be less than likely fee savings. In addition, the 3 properties are running 17% ahead of budgeted NOI as of February. Maybe Lily or Joe has the March numbers, but that should soften the impact of any value diminution. And the fund will have 87% of its equity available as dry powder to take advantage of market distress. Lastly, I'll mention that the investment is compliant with New Mexico State Investment Council's approved real estate policy, including such matters as investment size, manager concentrations, diversification, and leverage. So happy to open to questions, but we do have Lily and Joe on the phone to talk about the Bell strategy a little bit.
Let's pass it off to those folks.
Okay. Well, thank you, everyone. This is Lily Dunn. Good morning, and we are very grateful for the opportunity to present to you today. Sorry we're not together. It's obviously a very difficult time. We are focused as a company on supporting our 90,000 residents and 1,500 associates while also ensuring performance is maintained. But we are grateful to get on the phone with you today. I'm hoping that you have the materials in front of you, and I'm going to turn to slide 3, which starts with a unique culture. Do you have that in front of you?
I believe everything's done. I wonder, Paul, if you could just weigh in with what that diligent number is.
That will be diligent. Page 120 will be slide 3 of the Bell presentation.
Okay, thanks. That is a big deck. Okay, well, I know you have the opportunity to visit with many companies, and I'm going to take about 7 or 8 minutes if that's okay with you, but feel free to interrupt along the way with any questions or comments to focus mostly on who we are as a company, but I'll lightly touch on the apartment market, investment strategy, and any questions on terms. First, to provide an overview of Bell Partners, I like to begin with our culture. And I believe this is what sets us apart. It's the glue for our company. And the foundation of our culture starts with our purpose, which is to provide communities our residents are proud to call home. Our mission, which is also on this slide, starting again with a unique culture, is how we achieve this purpose. And the values, which is do the right thing every time, put the team first, serve somebody, outperform, prepare for the future today, Well, these are very important screens to which we use to determine what we will and will not do in our behaviors. And we take it very seriously, and it's a critical factor in hiring, promotions, and annual performance reviews. Lastly, our brand, which is We Care, We Deliver, is the experience that we hope that you will have with us. We value our relationships, and we're committed to delivering strong results. And it was nice to hear how important communication is with your GPs, because we take that also very seriously. I'm turning to the next slide, which starts with the Bell Partners overview. To give you a very quick summary, because I know you have a lot of information already, but quickly, we are a privately held, vertically integrated operator and fund manager focused only on apartments. That is our business. And the value add funds is really the flagship of what we do. We've been in business for over 40 years. We manage about 60,000 apartments across the United States, and we have delivered strong and consistent performance over several cycles, which I'll touch on more in a moment. We think that you have the best of both worlds with us. We have a national geographic footprint, which provides great economies of scale, but also deep presence within our carefully chosen markets and a hands-on approach to driving value. Turning to the next slide, starting with key differentiators, wanted to highlight three briefly. First is business intelligence. And this is particularly important in times when the market is changing, like now, and there's a lot of uncertainty. We've been investing in data analytics for years. This is not new to us. Our team provides real-time efficient access to internal and external data. We have a research-driven approach to selecting our investments and use tools to carefully evaluate market conditions so we can plan and adjust our business tactics accordingly, which we're already in the process of doing so. Also, our data analytics team helps us provide strong reporting capabilities, which further enhances our communication and transparency to our investors. Asset management is another differentiator, and this isn't just monitoring our financial reports. We have a dedicated team that develops customized business plans for each asset that's acquired, and they actively meet on-site with their partners in property management and construction to ensure the plans are executed well. Lastly is renovations, and we've done a lot of this. Over the last 3-4 years, we've renovated about 20,000 homes, actually probably more than that. We have access to top designers and contractors and can secure attractive pricing given our volume. And we also have a lot of techniques that we have done for a long time to maximize cash flow and minimize risk. Turning to the team, our senior management team has about over 25 years of real estate experience, and we have worked together in different capacities for about 10 years. 15 of about the 20 team members have worked with global institutional investors or REITs. And so I think what this provides is it gives an entrepreneurial spirit of a private firm combined with the strong disciplines, processes, and reporting that you can find in a public company. In addition, we believe we have very strong alignment. In addition to the 3 family members, there are 3 non-family members, of which 2 of the 3 are Joe and I, who are on the phone today, which we believe is a testament to meritocracy and succession planning for Bell Partners. In addition, all senior leaders, which is about 20 people, have personally invested in Fund 7. This is not a loan. These are after-tax checks, and it's not a promise to apply a future promote. Turning to slide 7, which is our performance, you can see here that given our 40-year history, we have extensive experience with investments over multiple cycles. Since 2002 alone, we've completed $15 billion of transactions, and the senior officers responsible for that track record are still with us today leading the company. Our net realized return is 17.5, and multiple, which we tend to be more multiple driven than IRR, is 2.1 over $7.6 billion of volume. And we have consistently outperformed across multiple cycles as validated by many third-party indexes such as Preqin and Cambridge. Next, I'm going to just briefly touch on the market opportunity investment strategy and then open for questions if you'd like. I know you have a lot of information, again, about the apartment market, with some highlights about apartments is compared to other real estate sectors, apartments have a very attractive long-term risk-adjusted profile. They provide liquidity, which helps reduce risk, and offer relatively consistent cash flow, and are generally stable given minimal concentration risk and 12-month leases. Slide 9 shows you a little bit more about the NCREIF returns and occupancy to highlight some of what I just mentioned. And slide 10, which is at the top left, it says market opportunity. This is where you can see that we are focused on 14 key target markets across the United States. These markets generally capture a disproportionate level of demand and have higher rental rate growth versus the U.S. We pick these markets based on their size, which we believe is important for residual risk, long-term demand supply factors, performance, and operational complexities. And now turning to acquisition criteria, we have a long-term view in our investment approach. Within our target markets, we're focused on strong locations near major employment and transportation, as well as retail amenities, because we believe these micro locations consistently outperform over a full cycle. Similarly, we're focused on high quality assets that can maintain their value again through a full cycle. Obviously, we still need to do something to add value to outperform, which I'll touch on in a moment, but I do want to focus on risk. And frankly, this is a big reason for our consistent outperformance over time. It's easy to look good when the wind is behind your back. Now is when companies are differentiated and frankly, when we shine the most. We have a research-led investment approach to our market and asset selection, as well as how we do our underwriting and our annual budgeting. We also have a disciplined investment process using a collaborative team approach. The people responsible for underwriting are the same people for executing. Unanimous investment committee approval. We focus a lot on diversification across geography and conservative financing. We're not looking to value engineer our returns through financing. Again, our long-term view on investing and approach to risk, I believe, is one of the key reasons for our consistent outperformance over time and through cycles. And on slide 12, which is the 4 key value creation strategies, you can see that we look to add value in 4 different ways. One is through renovation of older communities that are very well located. The second is enhanced operations, which is through our property management, where we can enhance cash flow given our vertically integrated platform. The third is to be able to acquire newer, higher quality assets in emerging locations. So these tend to be less than 5 years old, A- assets, and what I would call a B micro location, where we think there are strong fundamentals to outperform. And then lastly is pricing dislocation, and I think that was touched on briefly at the beginning, is that we understand how to price risk and take advantage of unusual opportunities and or solve a difficult problem. Frankly, given the dramatic events over the last 2 months, this will likely be a big area of focus for Fund 7. And I suspect that we will find some newer, high-quality assets with distressed owners who will need to sell, which will help allow us to produce a value-add return for the fund. The last slide is the summary of terms, and that was touched on at the beginning, so I won't repeat, but I am thrilled to say that 10 of our 11 investors in Fund 6 are committing to Fund 7 or have already closed. The one that is not is because they don't have an allocation to real estate anymore. Also, keep in mind that every investor in Fund 5 went into Fund 6. So hopefully this is a testament to how we value our relationships and our strong track record of consistent outperformance. As mentioned, our hard cap is $950 million, and at this point we have closed or have commitments for $875. We're hopeful that this is an opportunity, will be a good fit for you, and we can begin a long and successful partnership together. So with that, I'll open it to any questions or other comments.
Thank you, Ms. Dunn. Wondering, before I go to committee for questions, if Townsend had anything to add at this time?
Sure, this is Seth. Sorry, I was on mute there for a minute. So I would just maybe highlight a couple comments that were mentioned by both Paul and Lily. But so just to take a step back, the consistent theme in the current environment, I think that you've all heard from a lot of people on the phone today, is there's a great deal of uncertainty. Uncertainty around the capital markets, asset valuations, pricing, rent collections, the unemployment market, a whole host of things. But with respect to fundamentals, we do believe that the multifamily, the apartment demand will continue to be backed by the long-term trend towards rentership, and that this sector has generally shown to be more defensive over the long term. As Paul mentioned, and as you see, there are 3 existing assets in this portfolio. These represent a relatively small portion of the fund, and ultimately will not determine the success of the vehicle. But still, Townsend does currently view blind pool funds, 100% blind pool funds, to be more favorable in this environment. So for that reason, we have rated the fund as a qualified investment versus a buy-rated fund. And it's important to sort of distinguish what that means. So importantly, first off, is that without the seed portfolio, Bell as a fund and as an investment manager would be rated as a buy-rated investment. It's also too important to know. So what this distinction means. So whether buy or qualified rated, the fund is taken through the same rigorous underwriting and due diligence process at Townsend. The investment also is discussed, vetted, and has been approved by Townsend's investment committee, both on a fund basis as well as for New Mexico's commitment. The primary distinction between the 2 ratings is really that both are suitable for institutional capital. However, a qualified rating means there's one or more heightened risks that is currently present in the opportunity. In this case, it's the seed assets, as mentioned. So these 3 investments are projected to represent about 13% of the fund equity. The heightened concern goes back to really just the uncertainty on pricing. So while we are able to while we are unable to put a true value on these assets today, we'd be mistaken to believe that they're truly worth what they were purchased at back in December or January. As you can see in our recommendation, we also highlight, we also went into greater analysis around these assets. And there's also some exhibits in the Townsend memo highlighting each of these investments on their own. So quickly, and then I'll open up to any questions. Each of these assets are in strong markets, occupancy well above or above 90%, with good overall demographics. What that means is really rent to income ratios in these markets is over 4 times. And through the early stage, Bell's ownership, as Paul mentioned, these assets have generated above underwritten NOIs. One of the assets does include a renovation strategy. This is currently on hold. The others have either light renovation, or the other strategy is to focus on expense reductions. So the risks are well mitigated. However, determining the value today, again, is nearly impossible. Lastly, one of the headline topics today is the percent of rents being collected, tenants paying rents. And speaking with the Bell team recently, thus far, 90% of rents, over 90% of rents were collected in the month of April. I think May, June, and July will be more telling on really the forward views of these assets. But strong rent collection thus far, well above the national average that's been reported in many publications. So for these reasons, the fund is still being recommended today. There remains a lot of additional information in our memo, but I just wanted to highlight that before going and opening up to any questions.
Thank you, Seth. And I'm going to go now to the committee. Questions for our folks, Townsend or Bell?
Well, this is Lee. I have a couple.
Okay, Senator.
But just to follow up on the last issue that Seth brought up is what I wanted to ask anyway. But what is the approach given the 90% payment of rent? So what happens with the balance of the 10? Is it forgiven? Is it extended? How is Bell approaching that?
Sure. I'll jump in. And actually, I'm thrilled to say that we're actually a little above 95% at this time. So I think the important thing to remember with our assets is, given the quality of the assets and the location, we haven't been hit nearly as hard as some other sectors, particularly those communities that are focused on workforce and affordable housing, or assets that are in markets that are heavily dependent on tourism and hospitality. So we started from a position of strength. We have contacted our residents and worked with them to develop plans that will help them. And so sometimes that's been waiving late fees just to give them a little more time. We're certainly holding off on evictions. We have a big spike in our e-payments. Went from 67% to 86% within the month, but we're waiving the credit card fees for them. And we're also allowing our residents to renew their leases without an increase for the short term. Because, you know, when you step back and look at perspective, people need a place to live. And the residents right now are generally staying in place due to the health concerns and instability of the labor market. And I think given our, again, part of our branding is the relationships, and given that personal outreach and the quality and the ability of our residents to pay, we've been fortunate so far for April. I will say that I think May and maybe June will be a bigger concern. So we are bracing ourselves for that and have plans in place to work with our residents to help them.
Are you forgiving the balance, or are you just kind of letting them pay that over time?
We are not forgiving the balance. We are setting up payment plans. Interestingly, only 5% of our residents, actually 4.3%, have asked for payment plans. Other companies are much higher than that. If a resident feels that they cannot pay and that they need to move out, that we are being flexible and we're allowing them to break their lease with no penalty.
Okay. What is the average number of units in your complex?
I would say that it ranges between 250 to 300 homes in a community.
Okay. And then on page, well, I've got it on page 80 in mine. You have a comment I'd like a little more explanation on. Let's see. And actually, it's in Townsend's report. There's a comment that says, Bell's renter demographic is less likely affected by recent job loss in the service industry relative to strategies focused primarily on Class B assets. So I was trying to figure out what the demographics is, because it also talked about you're trying to be, I almost sense, more inner city where transportation was less of an issue. So what's the demographic that you're really targeting?
I would say it's a generally upper moderate income profile. So these folks, many of them, frankly, are able to, for example, work remotely versus those folks that are more hourly driven in hospitality and tourism are facing some severe financial hardships. So many of our residents are actually still working, but from home. And so I think that that has been very helpful in working through this issue. And in the locations, they are by major employment and transportation and retail amenities when they eventually reopen, but not necessarily inner city kind of workforce affordable housing.
Okay. And finally, maybe the last question, it probably goes to Seth or Vince, but we are allowed a seat on their LPAC, and it's my assumption that that seat is being filled by Townsend. Is that correct?
No, this is Paul Chapman. Generally, as the director of real estate, I'll take the LPAC seat, but may have one of the other team members take it as well.
Okay, thank you. That's all I had, Madam Chair.
Thank you, Senator. Other member questions?
Madam Chair, this is Tim.
Tim, I like their plan. I thought it.
Okay, Senator Jennings, do you have questions or just that comment?
No, I just thought it was good. I some of the market areas they were in, I thought were real good. That Frisco's was a real good place in Texas. I thought a lot of the stuff they had looked good.
Okay.
Madam Chair.
Well, I heard the treasurer actually first.
Okay.
Thank you, Madam Chair. I think the first Seth answered my question on page 76 was the difference between the buy-rated investment versus the qualified. But I guess I got a question for Paul. And so, Paul, on page 81 with the dead deal expense, they don't have anything in the pipeline now. We're committing 1.5% of this money. And I guess I'm asking you, what do you think, how long do you think it'll take them to deploy the money? And what do you expect the time horizon? Because that's an awful lot of money up front where we could be sitting for quite some time. It might be better to be sitting on cash.
I think that it will take a while before the market figures itself out and sellers capitulate to a new reality. To the extent there is a new reality, I mean, we really don't know whether the private markets are going to yield a whole bunch of distressed deals. I think that's generally the expectations when you're coming out of something like this. But I would expect a lull for the first couple of quarters as the market tries to settle itself out, and then I would expect to see, again, if there is distress, if there is pressure from lenders to resolve defaults and things like that, I would expect quite a bit of activity after that. But I think the folks from Bell can probably address how long they expect to deploy the capital.
Sure, happy to touch on that. Generally, if it was normal conditions, we dollar cost average in and dollar cost average out. Given the shock that has been discussed, we are on pause right now and relying on our internal and our external research, looking at our markets, which we feel are good long-term markets, but to help us assess the right timing. Best guess, I mean, there's a lot of uncertainty. There's obviously not a lot of data right now coming out. We are thrilled with what we've seen for rent collections, but I would guess that maybe activity resumes again in the fall. There's a lot of capital, frankly, pointed towards apartments and hard assets, given, again, the nature, as was mentioned, that they're defensive. So I would suspect that we'll see some activity in the fall. We're hoping for a slow start. But if we're not comfortable that it's an appropriate risk-adjusted return, we will save the dry powder and wait for the appropriate, particularly distressed opportunity where we can buy more of a core-like asset at a value-add return.
And Treasurer, sorry to just add to that. This is Townsend. Maybe two quick comments. So the fund does have a 3-year investment period, which is consistent with most of your private equity style of real estate funds. And one thing I mistakenly didn't mention prior is, although this investment has some pre-specificity to it, having nearly 90%, 87% of the capital unfunded today with dry powder available to take advantage of opportunities in the market, we see it as an extremely strong opportunity and why we're here discussing it. The last point I'll make is that the asset management fee here is a bit unique and plays in favor of sort of the issue you're bringing up. The 1.5% that you are paying on committed capital is just for the first 18 months. Now, that sounds still like a long time from now, but typically that committed capital fee is for the full length of the investment period. Here, it's just for half of it, about 1.5 years. And then it reverts back to the lower rate that you all will be subject to at a $75 million commitment. So you do get a little bit of a fee reduction after 18 months.
In addition, there's no catch-up, and so that does play into asset management calculations, which frankly the catch-up would be far bigger than maybe the reduction in the asset management fee. And there also is a discount for size on the asset management fee that would put you below the 1.5%.
Madam Chair, I guess another question for Seth. You brought up private. What do you think long term? Is private better than an REIT?
You know, it's a difficult question. Let me just answer that first. State that first off. Look, I think there's reasons we invest in the private markets and there's reasons we invest in the public markets. We've evaluated, have discussions with your staff internally about potentially looking at some of the public opportunities today, seeing the discounts in the public markets, but also, you know, you're seeing the volatility in your equity portfolio at the same time. So we could go on for a few hours if you want to have a full discussion on this, but at the current moment, look, we think that the private markets, you know, we do see a illiquidity premium within the private markets, and having that ability to sort of weather a storm like we are today and having the dry powder. But at the same time, there are opportunities in the public sector as well that we're taking a look at. A number of your funds in the private sector have the ability to take advantage of public market distress. The large, big, you know, allocator type funds like Blackstone is one of the well-known names in your portfolio that does do that. And they utilize your capital in that way. So there's an argument both sides, and I don't have a good answer for you right now.
Member Eichenberg, it's Jack Koch. I would add, and Seth hit on a lot of good points. I think historically, if you look at how you know, the market operates, is that you see a lot of volatility in REITs similar to small and mid cap stocks. So the rationale, one of the reasons why individuals invest in the private market is to somewhat dull some of that volatility that you see. Now, that said, if you look at over long periods of time, 15, 20 years, a core return comes pretty close to what the REIT market looks like in private. However, you're very time sensitive, and when you invest in and when you're ultimately coming out. So the goal of private certainly mutes some of that in the ability to further diversify your portfolio. So that's, you know, a couple of the rationales. And as Seth just mentioned, additionally, you know, right now, if you believe in the long-term nature of, you know, of real estate, you could look at the public market and see some pretty attractive opportunities. Now, however, you then once again are market timing, and you're making those bets on a you know, daily basis for the long-term nature. Whereas a strategy like this, you're going to ultimately, as Lily mentioned before, historically dollar cost in and dollar cost out of those investments, which we do continue to believe provides a prudent exposure. And furthermore, you're getting some of that small cap and mid cap stock exposure through your public equities portfolios.
Treasurer Eichenberg?
Sorry, Madam Chair, I muted you. I don't have any other questions. Thanks.
Okay, I think I heard Member Tejas.
Yes, Madam Chair, thank you for recognizing me. Just real quick, I appreciate the information, and it sounds like Bell's in a pretty strong financial position. But I just was wondering if maybe the SIC staff could comment on you know, the outstanding debt that Bell might have on the balance sheet, and just sort of comment on that with respect to sort of these issues related to a lot of companies not having a lot of cash on hand right now. It doesn't sound like Bell's in that situation, but could you just talk a little bit about how you reviewed the debt outstanding, as I would imagine that construction and capital projects like this would require some leverage?
So the strategy calls for leverage in the range of 60 to, this is Paul Chapman, I'm sorry, 60 to 65%. And so when you talk about balance sheet financing, you're not speaking of debt that the manager has. You're talking about debt at the property level, correct?
Correct.
So, you know, this multifamily tends to finance fairly well. So we tend to see a little bit more aggressive loan to values on multifamily. But with this fund, because there's all this agency debt available to finance multifamily. But with this fund, we've got 87% of the capital has not been drawn from investors yet. So there is almost more so than any other fund that we have right now. This fund has liquidity available to it to take on pretty much anything that comes along, whether that's an acquisition opportunity or whether that means defending themselves against competition in a market because of pricing. I think the fund is quite well positioned, and that's one of the reasons we like it at this particular point is there's so much dry powder available to invest, to address, new acquisitions, but also to make sure that their existing portfolio is taken care of.
All right, excellent answer. Thank you.
Do you have any more questions, Member Tias?
No, Madam Chair.
Any other member questions for the team? All right, can I have a motion?
Yes, this is Linda Ison. Based on the recommendations of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to Bell Institutional Fund 7, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold, second.
All right, we have a motion and a second on agenda item 4B. Any discussion on that motion? All right, with that, Kerry, if you would take a roll call vote on this motion.
Certainly. Commissioner Garcia Richard.
Yes.
Secretary Padilla Jackson.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Linda Ison.
Yes.
Harold Lavender.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
And Nick Tayes.
Yes.
Your motion passes.
All right, very good. Thanks to our staff, Townsend, and the folks from Bell that were able to join us today. I appreciate everyone's patience as we work through this different mode of having the meeting. So thank you all very much for being present.
Thank you, Madam Chair.
Great, thank you.
Thank you.
Pleasure.
Thank you.
All right, next we're going to move to the Brookfield vote. That is 4C, and I will turn it over to Vince.
Well, thanks, Madam Chair. Before you now, as manager quite familiar with, Brookfield Asset Management. On the phone are Chris Harris and Hadley Peer Marshall from Brookfield. And also we've got Axia on the phone, the consultant for this area and these types of strategies. Jen Wildman and her team are on the phone to present also to you. This strategy is headed for the non-core fixed income portfolio. As you know, we're building that portfolio out relative to the core, and we expect this to continue, particularly with treasury rates now down at 60 or 70 basis points on the 10-year treasury, so less than 1%, closer to 0.5% of yield on 10-year treasuries. We're concerned in terms of investing in core bonds that some of the activity that you saw last month or in March could be more of the norm, investing in core fixed income where yields are low. Our managers stretch a little bit for some credit in those portfolios to get a little bit of additional yield. But when stress comes into the markets, we see things like what happened with the PIMCO portfolio and the PGIM portfolio on a short-term basis. So, and then of course with rates down this low, the next direction's got to be up since we're so close to zero. The timing of that's uncertain, but that's likely the next direction that we'll go. So we're building out the core or non-core fixed income portfolio. We think this is a solid strategy for that general allocation to non-core type investments. So is that as a preview? Let me turn over to Jen and her team to make some comments, and then we can get to Chris and Hadley for a presentation from Brookfield.
Thank you, Vince, and thank you to the council for having us today. I think Vince set it up very nicely in terms of the go-forward plan for the non-core fixed income portfolio. Today's recommendation is for $125 million initial allocation to the Brookfield Infrastructure Debt Fund 2. The decision to invest in Brookfield, again, is part of the plan to bring the lending strategies and the non-core fixed income allocation as a whole closer to the long-term target allocation, which is also growing. This commitment will bring the total committed and invested capital to approximately $3.1 billion. The recommendation also serves to diversify the portfolio away from corporate credit. I think we've mentioned this a few times at these meetings, but the legacy assets, which you had in the portfolio many years back, focus a bit more on corporate credit, and we're looking to diversify away from that. Brookfield is a manager, obviously, that New Mexico State Investment Council is familiar with, through your past and current investments, I believe, in the real estate portfolio. And you also have some exposure to the strategy itself, which is infrastructure debt, via an allocation to GIP, which was approved last March in 2019. But in this case, the risk-return profile, differs, as does the sector focus. So I think GIP has a bit more of a focus on energy, transport, water, and waste, but Brookfield will focus on renewable power, utilities, and data infrastructure, in addition to some energy and transport. I'm going to stop there, and I'm just going to pass over the discussion to my colleague, Tim Nest. He'll provide a quick overview of the fund and our thoughts on the manager.
Okay, and good morning, everybody. So as Jennifer and Vince mentioned, we finished up our due diligence on Brookfield Infrastructure Debt Fund 2 for consideration in the non-core fixed income portfolio. As Vince and Jennifer mentioned, it sounds like Brookfield is certainly a firm that SIC is familiar with, so I'll keep my comments short, at least firm level. In summary, they're one of the largest global investors in real estate, real assets, and now through their acquisition of Oaktree and Credit. BAM is a Toronto-based organization and manages a variety of both public and private investment vehicles. Within infrastructure specifically, they are a market leader with over $100 billion of assets under management, a large part of which is managed through their infrastructure private equity fund series. More recently, they ventured into the infrastructure debt world, leveraging their market insights and sourcing channels to help provide junior debt capital in infrastructure projects on a global basis. The team closed its first infrastructure debt fund, BID 1, in 2016, and this fund is currently at the latter stages of its investment period. The infrastructure debt team is led by John Steinbach, a managing partner, Hadley Peer, who focus more on the North American side, and Ian Sims. And they're all supported by a team of 6 to 7 more junior investment professionals. So with respect to Brookfield Infrastructure Debt 2, or BID 2, this is really a continuation of this fund series. Specifically, they'll be focusing on originating junior debt capital to a variety of infrastructure projects and assets. The subsectors, as Jen mentioned, of focus may include renewables, transportation, utilities, some parts of energy infrastructure, and data. The use of proceeds may include acquisition financings, recapitalizations, refinancings, as well as CapEx or construction of new projects. Overall, they are targeting high single-digit, low double-digit gross yields. Importantly, these are unlevered yield targets, as this is predominantly an unlevered strategy, aside from the modest use of the subline subscription facility. Following are the terms for the offering. They're targeting around a $2 billion capital raise for BID 2. This is a private equity style vehicle, which features an investment period of approximately 3 years, as well as a subsequent harvest period. The fees are 1% management fee, with 15% carry over 6% preferred return. But it's worth noting that New Mexico State Investment Council is subject to a first close and size discount on the management fee, that Brookfield has agreed to honor, given the circumstances. The first close has already occurred, and the net return is they're targeting around the 6 to 7% net. I note that the first close happened in Q1 with about $800 million, which is approximately 40% of their target. And lastly, I mentioned that it's a clean book, so there are no pre-pandemic deals which could be vulnerable to a write-down or subsequent challenges. So that's a good thing. What do we like about this offering? Number one, as I mentioned, they're a leading global infrastructure platform that has wide-ranging experience across all different parts of the infrastructure market. There's a huge addressable market here. McKinsey, just one stat we'll throw out, I mean, they've mentioned over 50 trillion of global infrastructure needs. And on the debt side, that a lot of this will be financed with debt. In the near term, market volatility should create new opportunities for the team. Further, they are really focused on control positions in the debt tranches that they're targeting, where they often have buyout rights for the senior tranche. This offers more control and downside protection. They have a very strong origination effort, and if you look at the number of deals they do per year, it's quite selective. And finally, there's a good alignment of interest with Brookfield as the organization is committing up over $200 million to this raise. So overall, we think this is a strong addition to the non-fixed income portfolio. So we're happy to address any specific questions now on the investment opportunity. If not, I'll pass things off to the Brookfield team.
Yeah, let's hear from Brookfield first on their presentation, and then we'll open it up to questions.
Great. Thanks, Jen, Tim, and Vince. Madam Chairman, members of the council, this is Chris Harris with Hadley Peer Marshall. We hope everybody's safe and healthy, and we miss not being able to sit around that big table at the Capitol building as well, but appreciate the opportunity to present to you today. I've been fortunate to be the client relations manager in New Mexico for about the last 8 years, and our partnership goes back 7 years now with your investment in our global infrastructure fund. I also just wanted to point out that, that we are large. We're pretty proud of the presence we have in New Mexico. We currently have about well over $100 million of assets in New Mexico, including real estate, infrastructure, and also a 1 megawatt solar generating project in Santa Fe. So, we really feel like we're a part of the community in New Mexico and appreciate the loyalty you had for us over the years. With that, I'm going to introduce Hadley. Hadley's our managing partner. She leads the Americas, and she's going to take you briefly through the strategy and, welcome any questions as we go through it. Hadley?
Great, thanks, Chris. And I echo Chris's opening remarks, and thank you for letting us participate in today's meeting. I'll try and be brief and give an overview of 1, our strategy, 2, our performance, and 3, our opportunity set. We established this infrastructure credit platform back in 2015 in order to serve a hole in the capital structure that had developed on the backs of the global financial crisis. We generally provide subordinated debt, though you'll see some of our investments are actually at the senior debt level. But we classify our investments more in the junior capital bucket. We're not taking equity upside risk to earn our returns, but instead providing a few turns of leverage above senior debt with the appropriate amount of equity cushion to align our interests with the sponsor and to protect against the downside situations that may occur. We stay quite disciplined in terms of the definition of infrastructure, which includes, of course, high barriers to entry, predictable cash flows, essentiality, et cetera, and also the type of risk we're taking. In terms of the specific strategy, we built BID into our infrastructure equity platform in order to maximize our social or sourcing capabilities and to provide further downside protection through our underwriting process. BID leverages the significant deal flow that is generated through Brookfield's key relationships with various owners of infrastructure globally, leading to more proprietary deal flow. In addition, we use our operating expertise and asset knowledge to help in our thorough underwriting process. We conduct this due diligence by using our in-house capabilities, which includes over 400,000 operating employees, and we incorporate our sector and regional heads into our process. Before I switch to performance and opportunity set, I'll see if there are any questions I can answer.
I'm wondering if we could just maybe complete the presentation and then go to questions, if that's okay.
Of course, happy to. And regarding our performance, we underwrote all of our investments with a recession case in mind. It's not that we had a view around when or what the catalyst would be for a downturn, but we did appreciate the longevity of the most recent bull market. Our first fund, which is pretty close to being fully deployed, is performing above its target returns, even in the face of the current environment, and has a diversified mix of investments through the various sectors and regions that we invest in. Finally, I'll touch upon the opportunity set, especially in these interesting markets. We executed successfully bid one in a borrower-friendly market, but the current market dislocation provides upside to our strategy, as our type of capital is more valuable to borrowers than ever. Some sources of capital that are not readily available, while others are more unpredictable and less reliable, which is countered by our certainty of capital and ability to move in a relatively speedy fashion. We are seeing a pickup in all sectors that we focus on, so transportation, energy, utilities, renewables, and telecom. We're also cautious about certain risks currently in the market, but have seen an increase in the deal flow and are finding good investments with attractive returns. So I'll pause there as I've completed the presentation, and we'll open up to questions.
Thank you very much, Hadley. And so now we're going to go to committee for questions for Brookfield or Axia or our folks. Questions from committee? All right, with that, I'm going to ask
Madam Chair,
yes,
sorry, Madam
Mr.
Chair.
Treasurer.
I have some of the same concerns, Madam Chair. Thank you for recognizing me, that I had with Bell, which is Brookfield in its, and I think it's Axia that pointed this out, was in their investments in the previous fund were somewhat sporadic. That's on page 143. It has slow deployment of their fund one. And I was just wondering if we're in the same boat here as giving them $125 million, a commitment fee of only 1%, but whether or not they're ever going to deploy the money. And so I guess that's a question for Axia.
Well, I could provide our perspective, and of course, Hadley and Chris can provide some of the perspective on what they're seeing in the pipeline. But I guess one of the things I noticed is that the management fee is on invested capital, right? So I realize that you have to earmark some money for a potential future capital call, but you are not being charged right now to wait, right? So number two, I mentioned that.
But it's still committed.
Oh, 100%. I 100% appreciate that point, but just wanted to clarify that it's not paid on commitments, which would make that a worse situation. But number two, one of the things that is, and Hadley can elaborate, over the last several years, the debt capital markets have been very active for financing these type of projects, right? And even so, the returns on the equity sort of get more competitive as well, making their strategy more difficult. Well, the situation's changed now, right? So whereas a lot of deals were financed in the leveraged loan markets, you're seeing a whole tremendous array of problems that those issuers and the CLOs that were financing them are encountering now. So a lot of those are going to be coming due for refinancing in the next couple of years, right? So that's going to lead to a whole array of new opportunities for private capital providers like Brookfield. So I would argue that right now, probably transactions is just over as the shutdown's in place, new transaction activity will likely slow, and that's the case pretty much across all asset classes. But once things resume, I think groups with private capital and with the borrower relationships and the industry knowledge should be very well positioned, as the capital markets are going to be still dealing with a whole host of issues. But I don't know if Brookfield wants to elaborate on anything you said.
Sure, I'm happy.
Oh, I'm sorry, go ahead.
Sorry, Tim.
We do, I'm happy to just add a little bit more color if that would be helpful.
Hadley, go ahead. Are
Okay.
you not requiring that, Mr. Treasurer?
No, I think it was, I'd like to follow up a little bit with that prior to, if I could.
Okay.
Sure.
And that, under that slow deployment, again, on page 143, they have a 1.1x there, which is a total return of 10%, and that's cumulative. When did it launch? Fund 1. I know you have, as of 9/30/2019, the fund was almost 2 years ago, but what?
2016.
2016. So 10% over right now, we're at 2020, March of 2020. Okay, thank you, Madam Chair. I don't have any other questions.
Any further questions on this agenda item? With that, can we go to a motion?
Yes, this is Linda. Based on the recommendations of the Council Investment Committee, Fixed Income Advisor Axia, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $125 million to Brookfield Infrastructure Debt Fund 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
This is Harold, second.
All right, so we've got a motion and a second. Any further discussion on this motion? Kerry, if you could call the roll, please.
Commissioner Garcia Richard,
Yes.
Secretary Padilla Jackson,
Yes.
Treasurer Eichenberg,
No.
Peter Frank,
Yes.
Linda Ison,
Yes.
Harold Lavender,
Yes.
Lee Rothman,
No.
Tim Jennings,
No.
Nick Hayes.
Yes.
The motion passes 6-3.
Okay, I'd like to again extend the thanks to the folks who are on the phone with us, and just thanks for your patience in conducting the meeting in this manner, and thank you for being available to answer member questions.
Thank you, Madam Chair.
Thank you.
All right. Okay, we're going to go to agenda item 4D, and I believe that's Starla and RDK.
Yes, this is Starla, and this memo is on diligent page 211. And the SC staff and RBK recommending a temporary increase in the allocation ranges for 5 U.S. public equity strategies and 1 ex-U.S. strategy in order to minimize the transaction cost in the volatile market, and specifically all the cash inflows to the U.S. equity portfolio due to rebalancing will be invested in the Russell 1000 index, and this will increase the allocation to the Russell 1000 and decrease the allocation to 4 large cap, U.S. large cap strategies. And a U.S. equity structure study is scheduled in June, where long-term allocations will be recommended. And the ex-U.S. study that was presented to the CIC in March will be presented to the SIC in August and includes new allocations. Are there any questions?
Starla, did you want RVK to weigh in at all, or are you ready to take questions from committee?
I think we're ready for questions and.
Great. All right, questions from committee. All right, seeing no questions, hearing no questions, we're ready for a motion.
I'll make that motion. This is Linda. Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve increasing the interim target allocation ranges for the Russell 1000 Index Strategy, 4 active and factor-based U.S. staff strategies, that's T. Rowe Price, Brown Brothers Harriman, AQR, and Scientific Beta, and the MFS Large Cap Excluding U.S. Growth Strategy as discussed, reviewed, and memorialized by the Council today.
Second, Harold.
All right, we have a motion and a second on agenda item 4D. Any further discussion on this motion? All right, I'm going to ask Kerry to take a roll call vote on the motion for item 4D.
Commissioner Garcia Richard?
Yes.
Secretary Padilla Jackson?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Ison?
Yes.
Harold Lavender?
Yes.
Lee Rothman?
Yes.
Tim Jennings?
Yes.
And Nick Tass?
Yes.
The motion passes 9-0.
Very good, thank you very much. So we'll move to agenda item 4E, the contract extension. Starla, I believe that's you again. And Vince.
Okay. Vince, did you want me to do this or did you want to do it?
Well, I'll just start out by saying Starla and her team approached me a short while ago, after the crisis has hit, with some concerns about the rollout or potential concerns about the rollout on the BlackRock Aladdin system. That's going smoothly, but just in an abundance of caution, they asked if we could extend the FactSet contract for a few months, just to make sure that they were covered in terms of their analysis system on the equity portfolio. So I said, sure, let's take that to the council and see if we can get a vote. Any other comments you might have, Starla?
No, I would say that FactSet worked with us. They were exceptional in giving us the month-to-month versus the one-year contract. And then also, Clayton and I put our heads together and reduced all the services we could, reducing the cost by 35%, such as, going from 2 terminals to 1 terminal and such. So this is, this will help us a lot, at this month-to-month, monthly rate of $8,958 per month.
All right, with that we can go to committee questions. Hearing no questions, we ready with the motion?
I'll go ahead on this one too. This is Linda. Based on the recommendations of SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve the proposed month-to-month extension of the FactSet Analytics Service subscription as discussed, reviewed, and memorialized by the Council today.
Harold, second.
All right, we've got a motion and a second. Any questions on this motion? So do we need to go ahead and say for up to 2 months, or we're just going month by month? So wait and see. What are folks' thoughts on that, Vince?
I think isn't the motion a month-to-month extension?
With no limit, so just.
With no limit, yes, exactly. That was Peter speaking.
Yes, Commissioner, this is Steve. This is a month-to-month extension with no limit, but as soon as we can get Aladdin in place, Starla, am I correct that you'll move to Aladdin and you'll terminate this?
Yes, absolutely. As soon as we can get, reasonably comparable data on the Aladdin platform, we will definitely cancel FactSet.
Okay. Any further discussion on this motion? Kerry, if you could take a roll call vote, please.
Commissioner Garcia Richard?
Yes.
Secretary Padilla Jackson?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Linda Ison?
Yes.
Harold Lavender?
Yes.
Lee Rothman?
Yes.
Tim Jennings?
Yes.
And Nick Tayet.
Yes.
The motion passes 9-0.
Very good. If we could go to agenda item 4F, Vince?
Thanks, Madam Chair. I would ask that the council consider tabling this agenda item for today. I rather optimistically asked Steve to include it on an optimistic view of how quickly I can move on it, and I'm just not set to make a recommendation to you today.
Do we have a motion?
So moved. This is Harold. So moved to table.
Okay. Do we have a second?
I second that, Peter.
All right, we've got a motion from Member Lavender, a second from Member Frank to table this item. Do we need a roll call vote on a tabling motion?
No, I don't think so. No.
Any objection to the tabling motion?
No.
All right, all in favor signify by saying aye.
Aye.
Aye. Aye.
Okay, we're going to move to agenda item 4G, the asset allocation. Vince, again, this is your item.
Okay, well, we had a lengthy discussion in the investment committee meeting a couple of weeks ago about the tax stabilization reserve asset allocation, in particular, the 20% allocation to real estate. There was discussion about, given the effect of dropping oil prices, the typical effect on dropping oil prices on the state's budget, and the potential use of this fund, should we become a little more liquid within our long-term strategy? And the best way to do that would be to reduce the real estate allocation in favor of core bonds or the short duration portfolio. And at 20% allocation could be dropped to a 10% allocation, and that additional 10% be put into more liquid assets in case of use. I don't think it disturbs the long-term outlook for returns from this portfolio or expected returns for this portfolio, as we would anticipate this to be a short-term measure and then reallocate back to our long-term allocation, once this crisis is over and potential budget uses, declined in probability. But it was just a thought on the investment committee, and the committee committee asked that we have the same discussion at the council level.
Madam Chair, can I ask a question?
Secretary Padilla Jackson.
Thank you. Yes, so my question is, this is obviously super important to the near-term plans for state finances, and I wanted to ask, how long does it take to actually implement this reallocation if we were to approve it?
Member Padilla Jackson, I think, if we just did the 10%, which would be half of the allocation, we could do that on regular monthly cash flows. So I'm certain I could raise that amount of capital just on normal cash flows between the portfolio and the real estate portfolio. So within a 30-day time frame.
Okay, and what is the dollar amount that 10% equates to?
Well, I don't recall the size of the fund. maybe if Brett's on the line, he's just completed his IHR, but it would just be 10% of the current size of the portfolio.
Vince, it's Paul. I think it should be about $120 million.
Okay.
I'm
All
pulling
right,
it up.
well, thank you. Okay, that sounds good. I guess my last question, Madam Chair, is for Treasurer Eichenberg. I know I did support the idea of pushing this out. My only question on that was, did you say this was not properly noticed as an action item? Is that what the concern was, Treasurer Eichenberg?
Madam Chair, Secretary, I just questioned that there was no background of it in our book, and there wasn't a specific request to go from 20 to 10. It just said that we were going to discuss it, and that was the question that I had.
Okay.
But I would also ask Vince, if we're at 20% now and we go to 10, are we going to wind up with a haircut on that 10% anywhere if we try to do it in a 30-day or 60-day period of time?
We would get the book value, or we would get the unit value of the real estate portfolio, which is held in there pretty well. We had about a 0 to a 1% return in the real estate portfolio for March. So if there were a haircut, it would be minimal.
Okay, thank you. And I'm sorry, Secretary, I hope that answers your question.
Yes, it does, Treasurer. So I would just, in order to allow us to, and allow staff to have the maximum time possible, I would just recommend that, we look to having some type of special meeting so we can give them the flexibility and the authority to do this sooner rather than later.
Madam Chair, if I could, Madam Chair.
Yes.
I would like to actually broaden, and if we go to that special meeting and broaden back to what we originally talked about when the fund was given to the State Investment Council, they gave us the opportunity not to actually specifically give 20% to real estate, but to give staff that opportunity and break it down as to what they felt was necessary. And so I would like to take out the minimum of the 20% altogether. So if we do have a special meeting, I hope that can be discussed as well. That if Vince doesn't feel that he wants to invest in real estate over the next 3 years, he doesn't have to. Thank you, Madam Chair. That's all I have to say.
Madam Chair, this is Linda Ison.
Let's just make sure, Madam Secretary, were you finished?
Yes, thank you.
Member Ison.
This is a question for Vince. How much market rate risk or interest rate risk are we left with in that tax stabilization fund now?
Remember, Ison, there's not much interest rate risk in there now. We've got some core bonds, which is, as you saw in March, had some credit risk to it. Right now, rates are extremely low, and in the short run, I think we're likely to stay down here. As we go forward, we've got interest rate risks. We're so close to zero that the next move has to be higher. It's just a timing issue. Here in the near term, there's not a great deal of interest rate risk in there. We've put a good slug of that money into the short duration portfolio, but there is some core bonds risk in there. That potentially could have interest rate risk if rates start heading higher.
Thank you.
Member Ison? Yep. Any further discussion on this agenda item?
This is Lee. I have a question for Secretary Padilla.
Senator.
How soon do you think you would need them funds?
We would need the funds as soon as the special session. So we can't access those funds until they're appropriated by the legislature. And so as I was indicating earlier, the best information I have on the timing on that is sometime possibly as early as June. So that's what I would say is we would want to have the funds accessible by that time.
Well, I guess the question then though is having the funds accessible or just having the funding available. I mean, it seems to me that you wouldn't need to have those funds right away. You need to burn through some of the other pockets first, like the tobacco fund. Or do you really think that you're going to need this funding in June or July? It seems to me that you probably wouldn't need it until later on in the year.
Madam Chair and Member Rawson, I think that we would, likely need the actual funds potentially within the next few months of the special session. As Mr. Charlie Williman just noted, this would be a fund that we would access need to access prior to the Tobacco Settlement Fund. And so the thing I can't talk approved, but to the extent that the budget solvency plan includes, $200 million from the tax stabilization reserve, that money would need to be accessible sooner rather than later.
Okay, now there's also considerable money coming from the federal government directly to the state for support of various, different groups, whether it's schools or hospitals or other things. The state is still getting some federal funds, and there's always been some battle between the legislature and the executive in terms of who controls that. Does it have to be appropriated since it's coming from the federal government, or is the executive taking the position that she's going to direct how that fund is being used, those funds, and so therefore those funds then are not going to be considered in the special session because it's going to be the governor's fund to do what she wishes within those categories. So can you tell me what the executive's perspective is and how much money the state is expected to get from those various pots?
Sure, Jackson, just to your comfort level, because the executive actually isn't here to answer for herself. So as much as you feel comfortable answering the question.
Sure, I appreciate that. Thank you, Madam Chair. So I can speak generally to some of those items. So one, generally with federal funds, the executive does have the ability to adjust budgets and include those in the respective agency budget. So that's generally a rule of thumb. With federal funds, we have the ability to put those into the budget and use those, especially for emergency type situations. As you indicated, the federal government has allocated there's various pots of money, but just shy of $2 billion to New Mexico for various types of expenditures in different policy areas. The big one being the Coronavirus Relief Fund, and that one is $1.25 billion that was allocated to New Mexico. And specifically, it is for response to the COVID emergency health crisis. And there is now, as of last week, more detailed guidance as to the type of expenditures that would qualify to be able to use those funds for. So all of that being said, it is not allowable for any states to use the funds to address the impact of the revenue losses at this point. That's still a point of discussion, and the talk is that in future legislation that restriction may be lifted, in which case some of those funds might be allowed to offset some revenue losses. But as it stands right now, it's pretty detailed and specific in terms of the types of expenditures that we can use those funds for, and those funds are currently being budgeted.
And why does it say that $2 billion is in excess of what we expect to lose in terms of revenue to the state in general? Is that correct? We just can't switch one for the other.
Yeah, Madam Chair and member, yes. So just a couple of things. One is when you look at the entire $2 billion, that $2 billion is very specific in terms of types of uses. It covers things like school meals and childcare and transportation. So I don't think you can mix and match the two things and equate the amounts together like that. The coronavirus relief fund is the one that the 1.25 billion that they are considering allowing that to be used for some of the lost revenue. But as you can imagine, a lot of that will have to be used for the emergency response.
Okay, that helps me. Thank you very much.
No problem. Thank you.
All right. Thank you. Further discussion on this agenda item, and I'll just remind folks that we had an amendment on our agenda that this was going to be discussion only. Hearing no further questions, I'm going to go to agenda item 5, and we'll start with Member Frank on the Audit Committee report.
Okay, the Audit Committee did meet yesterday telephonically. We covered quickly the quarterly reports from our auditors, which are normal and standard, no exceptions. We spent most of the time discussing the budget, and I will not comment on that other than to say that we approved it and recommended it to the council for approval as is appropriate, and Brent will walk us through that and take any questions that the council might have. But we spent most of our time on the budget and noted that it is in line. It's in line with the generally with minor changes to the appropriation that was approved last year. The last thing that we did cover was the Colmore audit process that is continuing, and that is a consultant that we've hired over the last year or two, maybe longer, to investigate and audit management fees, carried interest calculations, fee calculations from our investment managers. That has been a very productive exercise and is a very important part of our overall internal audit and control environment, and one that we were quite pleased with. So, Brent, I will turn it over to you at this point.
Sure. Thank you, Peter. Madam Chair, fellow members, I'm on page 215, and I'll go through this really quickly. This is a summary of our budget to actual for March of 2020. We have 3 months more to go in the fiscal year that we're in, fiscal year 20. If you go over to the right column, and I just want to give everybody assurances going into the last quarter of the year, and we're currently paying management fee invoices for the third quarter, and then after the fourth quarter ends, we'll get all the management fee invoices. We do show significant budget savings through the end of the fiscal year. I would expect most of these savings to hold up through our audit. You might see category 300, which is all of our contractual services. That has the biggest budget savings. That might be adjusted downward a bit, but I'm still expecting to finish the fiscal year very strongly in terms of the budget. And certainly, everybody should be mindful of the fact that there was a big market downturn, and because of that, there's fee savings as it relates to reduced asset prices and corresponding fees that go along with that. And then if you could flip over to Diligent Materials 220, I just wanted to point out a couple of things, if I could, on the investment holdings report. You'll note for this current investment holdings report, if you go down to the very bottom, you'll see that it's 61 pages long. That's a very long report, especially due to the fact that you have to go through it all. But I just wanted to point out, in addition to the notes page, which is the last page, the report is basically broken down into 3 sections. The first, 9 or 10 pages is kind of a snapshot of the individual funds. In fact, we had a question on the Tax Stabilization Reserve Fund earlier. If you go to page 226, there was a question of what the real estate investments were at as of the end of March. And you can see going down to the bottom of that page, real estate investments as of 3/31 for the TSR fund is $212 million. And I think Paul Chapman said 240 or 230, so he was right on the mark there. And then if you thumb over to page 222, I just want to make sure everybody understands how this report is organized. This is the report for the Land Grant Permanent Fund. This is the section of the IHR that's kind of a snapshot. You can go through as of the end of March. If you thumb down to the bottom of the page, you can see that it has $17.915 million as of the end of March. Well, if you thumb over to page 237, you can see that 237 on the far right-hand column has the same total, but you're rolling it forward from the prior month. And as you can see, in the gains realized and unrealized, there's a lot of red in those columns. That relates primarily to the drawdown in March. If you thumb over to page 262, this is you end up with the same total in the far right-hand column, but this is a roll forward for the full quarter. And you might say, well, it looks like the losses in that loss column is larger for the March quarter versus the month. And if you recall from Vince's presentations earlier, the quarterly loss for the Land Grant Permanent Fund was a little over 9%, and the monthly loss was close to 6%. I think it's 5.83. The point I'm trying to make with the IHR, with every fund that you're familiar with, whether it's the land grant, the severance tax, the tax stabilization reserve fund, the library fund, the tobacco fund, within the IHR, you should be able to locate not only a snapshot. If we're on a quarter end like we are for March, you should be able to see not only a monthly row forward, but also a quarterly row forward. And that's all I wanted to say on the investment holdings report. If anyone has any questions, I'm happy to answer those. And then as it relates to the fiscal year 21 budget, if you go over to page 282, I tried to make this as simple as possible. We had a pretty fair amount of discussion yesterday. I think Peter pointed out there were slight adjustments to our original appropriation request. The original request for fiscal year 21 was $58.4 million. We ended up getting it approved, and I think it was the executive recommendation that was approved for $58.212 million. That amount is what is approved within House Bill 2, and then there was two adjustments to that appropriation request that was approved related to raises of 4% and an added retirement contribution for 0.5%. The raises amounted to $131,300. That's for all employees within the organization, and the added retirement contribution related our total $13.8 million. If you add those amounts to the appropriation that was approved within House Bill 2, you get to the $58.3 million. I do want to point out that the budget is organized, as was the summary that I discussed earlier, into three categories: the 200s, the 300s, and the 400s. About 7.5% of the budget relates to payroll and related costs. Over 90% of the budget relates to contractual services, and a little bit over 1% relates to the 4%. There was a decline over the fiscal year 20 budget of about 5%. I would expect going into fiscal year 21, we will continue to likely have very strong budget savings into fiscal year 21. I have no budget concerns at all. I do want to let everybody know we have gotten memos from DFA kind of specifying, what the state is trying to do to, look out for the budget on the general fund side. The budget for our office is funded by the land grant and the severance tax. We draw those monies down over the course of the year in 6 installments. Any monies that aren't used, if there are budget savings as of the end of the fiscal year, corresponding to the completion of the audit, those budget savings are reverted back to the original funding sources. And those are all the comments that I have on the budget, unless there's questions. Thank you.
Thank you so much, Brent. And Member Frank, any questions for Brent on the investment holdings report, on the budget, projections for the upcoming fiscal year?
Madam Chair, this is Linda Ison. I had a question regarding Colmore, and they've been doing the analysis on all the fees, including Kerry, on the private assets. Do they produce any type of a report to let us know what those fees are that could be presented to the SIC?
Is Bruce on the line? He's probably a better person, although if he's not, I can take the question.
Yeah, I'm here, Brent. So Linda, your question was whether or not they have reports that list out to Kerry of all the funds we have.
This would be the fees and Kerry. We hired them so that we would know what type of a haircut we are taking on all of these private assets, because it's so hard to analyze. And so I was wondering if we have a conclusion as to what we're paying between fees and Kerry.
Yes, they've been producing quarterly reports to us. The next, and they're often on a lag basis because, well, the funds themselves are lagged 3 months, and then it usually takes about 3 months for Colmore to analyze all the information. And in terms of data, the best data always comes in December, or the end of December from all of the funds. So they're going to produce another report for us based on, end of year information that should be ready sometime in June. But they have very detailed reports. And in terms of whether that could be produced, I'm not sure if we would want to produce it on a fund by fund basis, but it seems like something,
Bruce, did we lose you?
We lost him. What happened?
Hello, can you hear me?
Yeah, we can hear you
now. You hear me? I'm sorry?
Yes.
We can hear you now. I think what Linda's asking is what kind of results kind of report could we get from Colmore, in terms of status of all the auditing that they have done?
Well, again, it depends on what kind of detail you want, but I think something that would be useful for you to see would be which is something they produce to us quarterly, is a report by asset class in terms of fees and expenses and carry.
So why don't you produce one of those for the council at the appropriate time, and then the council can decide whether it wants to see anything more.
That sounds good. I would suggest, I think we would have something either for June or July, depending on when they finish the 2019 reports. But that would be a useful time period to give to the council, I think.
I think just an annual report so that we have some idea as to what we're actually paying for those private assets would be sufficient. And I don't think we need to drill down to fund by fund at all.
Yes, we have been reporting aggregate fee information, not through Colmore, but I think Brent and his team prepare that report, and I don't know that I've seen one in a while, but that is available. Brent, can you remind me?
Yes, I would point out we do I think requested LFC reporting on an annual basis, usually corresponding to our fiscal year. So, I think Bruce pointed out that the calendar year information or the reporting that COMOR does is probably the most solid. But we do provide some mail FC reporting on a recurring basis. I would point out there are a few differences between the way COMOR does their reporting and the reporting that we do to LFC. We pull the reporting to LFC based upon cash flows that we actually have in-house. COMOR does some estimating, some other things. Their reports are probably more on an accrual basis. Ours maybe a little bit more on a cash basis, but certainly we can do some enhanced reporting as the council would like.
Yeah, I think what Brent's getting at there is the cash flows that we see are there's often an offset between funds that are being returned to us and management fees that are paid. So, if we get money back, it might be less management fees that are not otherwise recorded. COMOR traces those unreported fees that don't show up in the cash flows, but that we're nonetheless paying. So it gives a more complete picture, that follows more closely with what the contract actually calls for us to pay. So,
Member Ison, or do you want to see something before that December report?
So I think just what you feel is the most reliable period. It sounds like an annual report would be great for when all the data is the most reliable. I just think it's valuable for the SIC to understand what those investments are costing us and make sure that we are within the industry standard as far as what we're paying versus what other funds our size are paying in those type of fees.
I can tell you that just roughly, they've done some work on that for us. And in terms of fund by fund, they've done some analysis in terms of what we're paying versus what everybody is paying for a particular fund. So in other words, if we're using private equity fund ABC, are we paying our fair share of ABC's management fees relative to the other limited partners? And the answer to that question is yes, we are paying our fair share. We're not overpaying. Also, we have also, there's a correlation generally between the size of the fees and the size of the returns, the net returns. But all of that information would be available in an annual report for you to see. And I think it would be useful for you to see.
Thank you.
Any other questions for Brent?
Madam
you, Bruce.
Chair, Madam Chair, this is Nick Days here.
Number 2.
I attended the audit committee meeting yesterday, and we talked a little bit about how this budget is due to be submitted to the FA on May 1, I believe. And, there's a deadline that is important to meet, of course. And obviously this budget was approved back earlier in the year when we had a much different economic complexion. We did have a discussion on the likelihood of a budget adjustment needed. And Brent did mention that that's a common thing that's available to be put into place. But I would just want to inform the council that, there's likely a budget adjustment that will be brought forward, especially in terms of the likelihood of large budget reductions in the general fund. I know that the state investment council operations are funded differently, but especially in terms of compensation increases, I think we all need to look at compensation according to that budget adjustment, and potentially adhering to the spirit of any compensation reduction that's applied in the general fund and seeing how that does apply to the budget at SIC. So just a little comment there.
Thank you for that reminder. Yes. Brent, did you want to address that at all, or?
No, I did mention yesterday during the audit committee, we do have the ability to do bars. We always, on a recurring basis, have bar language put in to our packet. As of the time that we did our appropriation request, which was due in September, and we did at that time, I think, came down to a 5% reduction. You kind of have to step back to September and say, where was the market out there? It was in a pretty good position. It went up over the next 4 or 5 months, and now it's come back down. The budget that or the appropriation request that we proffered considered normalized investment returns. So I would think, based upon the budget that we see here before us, we're probably going to, unless something drastic happens, we're probably going to finish fiscal year 21 without the need for a bar. But if the market really started rocking and rolling outside of historical norms, we could need a budget adjustment request. But at this point in time, I'm not anticipating it.
Thank you. Any further questions? All right. Well, thank you very much, Brent and Member Frank, for your presentation. We're going to agenda item 6 now. Any old or new business before the committee?
This is Lee. I was wondering if Steve was going to comment at all on the SBIC.
Of course, Lee. Charlie sent out to all council members a really thorough report that we received from Russ Cummins, who runs the SBIC office. And we would be happy to gather more information if you need it. But I think that probably tells you more than you would like to know. Lee, if you have other questions, let us know.
Steve, this is...
All righty, thank you.
It's Peter.
Yeah,
Frank.
this is Linda. That SBIC report seemed to me that they were not looking at those funds as an investment by the SIC at all. They were not giving any indication at all that we would get any investment return on the money that they receive. So basically, it's looking to me that the 2% to the SBIC is considered by them to be a distribution and not an investment where we are expecting a return. And I also don't remember them investing in housing loans previously.
Would it be helpful to the council if we asked Russ and perhaps the chair of the SBIC to be available at our meeting next month?
That sounds great. We will do that. Member Frank, did you have more you wanted to add?
No,
I heard you.
Yes, you did. Yes, I agree with having them come in front of the council. We have, over the last we've had the last 10 years, we've had the realization that expecting any kind of cash return from that fund is fairly heroic at best. And it, of course, in my mind, calls into question the way we account for that fund. We account for it as an asset on our balance sheet. We don't reserve against it. And we assume somehow some sort of repayment, and we, of course, it affects our return. I continue to think that some thought needs to be given to whether that is appropriate accounting.
Well, at the very least, I think to have a chance for folks to ask their questions directly to the SBIC. Would that work for you, Member Rawson?
Yeah, that'll work. I'm sorry, I had to get to my mute button. That'll work great.
Any further old or new business? Okay, our next SIC meeting is going to be Tuesday, May 26th at 9 a.m. I believe we may still be in a holding pattern as to whether or not it will be an in-person meeting. So just please watch for that and watch as well for a possible special meeting on the TSR. So with that, we're going to go to public comment. Mr. Woolman, do we have any public comment to be read?
Madam Chair, we do not have any public comments submitted to us today.
Thank you very much. So with that, I can take a motion to adjourn.
So moved.
I'll second that, Stuart.
Okay, sounds like we have a motion and a second. Any objection? All those in favor signify by saying aye.
Aye.
Aye. All right. With that, we are adjourned. Thank you all.
Thank you all very much. Bye.
Thank you. Everybody, stay safe.